I would have probably placed it over this candle just because I like the reward to risk. It makes it a better reward to risk setup. And we actually ended up, having a huge, tremendous drop before we formed for a sell setup right here, and we had another drop. So there's a lot of patterns in here. We have a base breakdown short. Then we have a 1, 2, 3, 4, which is, like I said, the same thing as a 1, 2, 3. Then we continue lower. We actually have a climactic buy setup reversal play, which we haven't talked about that yet, but we have that here. And that's where you actually play a reversal. Then we have a sell setup. We have a declining 20-day moving average. We have the sell setup that worked. And wow, I mean, there's a lot of strategies that's in this screenshot. And you could see that this 1, 2, 3, 4 served as a secondary entry just in case you missed this initial breakdown. Okay, hopefully that makes sense. And that's really it, guys. So the 1, 2, 3 is not a difficult setup, guys. It's just a continuation play. And you could just see from these examples that it's not that hard. They're pretty easy to pinpoint. Remember, we have to have an igniting candle, right? We can't have something like this, right? This is not a 1, 2, 3. It needs to ignite a new move higher. That's the whole point. And this works on any time frame. And hopefully you can begin seeing 1, 2, 3s on your charts, and you can begin applying them, right? And start actually trading them. All right, guys, perfect. Let me know if you have any questions on that, and have a great day, guys. What's going on, guys? Hope you're having a great day. Today, we're going to be talking about another trading strategy and another trading setup that you guys need to add to your arsenal. And this one is going to be focused on picking reversals. It's called the exhaustion and the climactic pattern. And what this strategy is all about is, picking reversals with precision. So far, with the base breakout, with the buy setup, with the 1, 2, 3 pattern, we've learned how to play with the trend, right? If we're in a solid uptrend, we've learned how to find setups in that solid uptrend, or how to find setups in that downtrend so we can play short. But today we're going to be talking about how to go against the trend, okay? And before I hop into the presentation, I want to give you guys a little diagram of exactly what I mean showing you guys this. So let's go to my little drawing area, okay? Let's say we have a 20-day moving average that's, let's say, trending higher just like that. Let's make this moving average this orange. And let's say we have price. Let's make this actually yellow. Let's say we have price, respecting the 20-day moving average and continuing this uptrend. Okay, so let me just draw this real quick. Very good. So right now, and we could even make this a little flatter, maybe make it more like 45 degrees. Perfect. Okay, so what we have here is a gradual uptrend. We have an uptrend that it's just grinding higher and it's gradually continuing higher. Okay, so this isn't where we're going to find a reversal. Why? Because price is near the 20-day moving average. We talked about in some of the other classes that extension is when we have distance between price and the 20-day moving average. And we're really going to be diving into this idea of extension during this strategy. But let's say all of a sudden, we talked about how the slope of the 20-day moving average matters, right? And the higher the slope is, the more unsustainable the move is, right? So right here, let's say we have let's just call it a 45-degree angle. And let's say all of a sudden, let's make this same color, yellow. The 20-day moving average starts to, it becomes basically steeper, right? It starts to kind of curl even higher and make a kind of a higher angle. This is 45 degrees. Maybe at this point, this is more like 60 degrees, right? And we see price start getting really extended from the 20-day moving average to the point where there's even, let's say, even higher, right? And you see that there's a ton of distance between price, right? Let me make this a different color. Make this like orange. Let's say there's a lot of difference between price up here and the 20-day moving average down here. You can see this is the price, this is the distance that's representing that. So what do we do up here? Well, we don't want to play long up here, right? Why? Because number one, we're extended from the 20-day moving average. Remember, we talked about we want to take entries that's at or near the trending 20-day moving average. At this point, we're really far from the 20, right? The other thing is we had a huge move higher, and we don't want to buy at the highs. So what do? This is actually the exact point where we're going to be trying to find a short, where we have extension in this sort of acceleration. So now that you guys get the general idea of what I'm talking about and how we're finding this reversal setup, let's actually go into the presentation and talk about details and specific things that we're looking for. So this is called the exhaustion play. You could also call it the climactic pattern. And this is honestly the most potent reversal setup. This is the only way to pick reversals, right? I think there's this amazing idea where traders, they just want to pick the tops, they want to pick the bottoms in stocks, right? There's just this like idea behind it where it's just like, oh, you're buying it at the absolute bottom or you're shorting it at the absolute top. And that idea is so appealing. So if you're one of those traders who is really trying to find reversals and that's just what you're inclined to do, that's just like what makes sense to you, then this strategy is going to really help you with that and help you take, your trading to the next level, especially with the strategy. So something to understand, guys, I think truthfully, this is the most difficult trading pattern. If you're a beginner, I would say stay away from this pattern until you're a little bit more experienced. And the reason it's the most difficult is because your odds of success is always greatly increased when you play with the trend. You usually want to be going with the trend, right? If the charts are saying bullish, if there's an uptrend on several time frames, right, and everything is screaming bullish, well, you should play long, right? You should go ahead and look for buying opportunities because everything is telling you that there's a lot of buying pressure. So going short in an environment where there's a lot of buying pressure, that's difficult. And a lot of times you're going to take some trades with the exhaustion or climactic pattern, and it's not always going to work out. They have a lower likelihood of success, right? Especially when you don't know the specific details that you need for the setup. So it's difficult. Just stay away from it as a beginner and start doing it when you're a little bit more experienced, I would say, but it's up to you, obviously. So like I said, you typically don't want to play against the overall trend. However, you should still be equipped with the knowledge of how to do it correctly. And the thing is, guys, since we're trying to catch tops and bottoms, this setup might take more than one try, right? Like if you're finding one of these setups, you might have to enter it more than once because you have a high likelihood of getting stopped out if it continues like in that direction. You know what I mean? And that'll make sense in a little bit here. So let's talk about the setup. So first requirement is we have, in this case, this is a climactic buy setup, right? Or exhaustion buy setup because we're going to be buying in this situation. So number one, you need a declining 20-day moving average, right? And ideally, we talked about slope. Ideally, the slope is very steep with the 20-day moving average. So declining, it's overpriced, perfect. Acceleration. So let's talk about acceleration. We kind of mentioned acceleration, and I kind of showed that idea. Oh, where did it go? I guess my drawings got deleted. No problem. So in terms of acceleration, notice here that these red bars are becoming increasingly larger. And for the climactic pattern, for this pattern, you need to have at least 5 or more red bars in a row. Actually, let's start over here before we go on to acceleration. So yeah, you need ideally 5 or more red bars in a row, and you need 5 consecutive lower highs, right? So 1, 2, 3, 4, 5. That's 5 red bars in a row, even 6 actually. And you could see we're making lower highs on each red bar. Those are requirements. And we're going to be looking for clear extension and acceleration. And the whole idea of this setup is we're trying to buy the stock or crypto when supply is about to run out. Like there's a lot of selling at this point right here. We can be confident that supply is starting to run out, and that's when we're going for the long, and that's when we're trying to buy it, because there doesn't need to be a lot of demand to bring this stock or crypto up from here. Because if there's zero supply, if there's zero people selling it down here because they already sold, then any amount of buying pressure will bring this back up. So we talked about acceleration. Notice how these red bars are becoming increasingly larger and larger. Notice that the distance between price and the 20-day moving average is becoming increasingly larger, right? Like here, there's not that much different distance. Here, there's more distance. Here, there's even more distance. And all the way down here, there's a lot of distance. That's what I mean by acceleration. The candlesticks are becoming increasingly larger. So we need to see this acceleration. It cannot just be a steady and gradual decrease. Okay, this is a really, a lot of people get this wrong, where they'll see a very steady and gradual downtrend and they'll try to find a reversal. No, you need to have this acceleration. We also talked about, extension from the 20. These are kind of connected, the acceleration, the extension. As it's accelerating, it's going to become more and more extended. And the larger the distance between price and the 20-day moving average, the more oversold the stock or crypto is. So if there's a lot of distance between price and the 20-day moving average, like in this scenario, you could think of it as this is oversold and there's probably going to be a correction higher. We also talked about volume already, or if we haven't talked about volume yet, it's going to be in the next class. And you could think we also need a large volume spike here. And the volume spike, we talked about amateur and professional volume or igniting volume. So we want to see a ton of amateur volume down here. Okay. And so hopefully those are the three requirements there. We have acceleration that causes, right, the acceleration, increasingly larger red bars that causes the extension from price and the 20-day moving average. We have a huge volume spike indicating a reversal. And once we have one of these entry bars that we talked about that with the buy setup. Once you get one of these entry bars, you place your entry over the entry bar and your stop loss under the lows of the move. So that's what's key. It has to be under the lows of the move. So let's talk about the importance of entry bars. We already talked about this with the buy setup. You guys should already know this. We're looking for narrow range bars, or we're looking for doji bars, or for bottoming tails. Because remember, if we get a bottoming tail right here, it suggests that that the buyers have started taking control. So an entry bar, it provides us a clear entry and a clear stop loss, right? Entries above the entry bar, stop loss below it. It increases our reward to risk. And we're always going to put our stop loss under the very lows of the drop. So wherever the lows is of the drop, that's where we're putting our stop loss. So if it continues lower, it'll hit our stop loss and we'll exit immediately. Let's look at the opposite. This is a climactic sell setup or an exhaustion sell setup. You could see here we have a rising 20-day moving average. You could see price. Well, number one, we need ideally 5 or more green bars in a row and 5 consecutive higher highs. You can see we have higher highs. Okay, 5 green bars in a row. We're looking for acceleration. Notice how the green bars are becoming increasingly larger and larger, causing extension from the 20-day moving average. You can see the distance here. Okay, obviously the larger the distance between price and the 20-day moving average, the more overbought it is. So if you see a lot of distance between, or you see a lot of extension between price and the 20, you can assume that it's a little bit overbought and a correction might take place. And of course we have a volume spike at the highs indicating a reversal here. Okay, it's the same exact thing, except obviously the opposite. Our entry in this case would be shorting under the entry bar, stop loss is over the absolute highs of the move. Okay. So, you know, whenever you have a huge rally like this and you get narrow range bars or topping tails or even bottoming tails, doji bars, small bars like this, those are entry bars. They enhance the shorting opportunity. It gives you a clear entry and stop loss, obviously better reward to risk, and we're always going to put the stop loss over the highs of the rally. Okay, hopefully this makes sense for you guys. Now let's look at some examples and let's kind of check off everything we need to know here. So number one, do we have a rising 20-day moving average? Yes. Is the 20-day moving average, is the slope increasing? Well, you can see it's curling. You can see the slope is slowly increasing to the point where here you could see that, you know, this is much greater than 45 degrees. This move is probably, you know, based off this moving average, the move is probably not sustainable, right? Now, looking, do we have, well, acceleration? Okay, well, first we move up, then we kind of base, then we start to grind higher until eventually we start to see some clear acceleration, right? The bars are becoming bigger and bigger and bigger. We kind of had 2 little breaks with these bars, but right after that, we get one huge bar, another huge bar. And with this topping tail, this was being bought before. The highs was up here, right? So you could see clear acceleration. The bars are becoming increasingly larger. There's clear acceleration, right? We also have extension. I mean, look, at this point, we're kind of close to the 20. We're close to the 20. We're close to the 20 until boom, huge rally. At some point, we were all the way up here. Look at the distance between price and the 20-day moving average. Clear extension. And we also, at the top right here, right, huge spike in amateur buying volume up here. Huge spike in volume, suggesting a reversal. Where would our entry be in this case? Under this candlestick, that would be entry, and then stop loss up here. Okay. We also get a topping tail, by the way, which shows that the sellers have taken control. Let's look at another example here. We started from the 20, huge rally higher, right? This might have even gotten halted because we have a gap here. Oh yeah, by the way, guys, for this setup, the target is always the 20-day moving average. So this would be this is target. The bars are becoming increasingly larger. This is not a perfect setup. I kind of want to show you guys, you know, not the best setup, just to show you guys that, you know, you don't need a perfect setup like this to play this pattern. Entries right here, stop losses over the highs. We have the extension as well, so nice. This is a really, really beautiful setup here. So let's take a look at it. You could see move starts from the declining 20-day moving average. You could see the 20-day moving average is curling, starting to curl lower and lower and lower and lower, right? And we drop, we kind of base here, we drop again, little retracement. We start to drop, base, and all of a sudden you could see the acceleration right here, really starting where we really accelerated, right? You could see the bars are becoming larger and larger. We don't get the volume spike. So in this case, we didn't get the volume spike. That doesn't mean that this is not a good pattern just because we don't get the volume spike. Everything else, the acceleration, the extension from the 20-day moving average, it was telling us that it was climactic and it was exhausted. And the reason it's called exhausted, right? The reason I say exhausted is because in this case, the sellers have been exhausted. In this case, the buyers have been exhausted up here. There's no more demand up here, causing the sellers to bring it down. Here, there's no more supply, causing the buyers to bring it all the way back up to the 20-day moving average as target. Entries over the highs, stop loss under the lows. Let's look at another example. So guys, if you guys are looking at this, you should immediately be able to identify the setup that this is stemming from. This is a breakout, right? We have a rising 20-day moving average that's curling under price. We base into the moving average. We start to break out. We start to get the acceleration, right? Huge volume spike up here, showing amateur buy volume and then professional igniting volume, right? Because that's when we started to move lower. We have distance between price and the 20-day moving average, right? There's clear acceleration, really nice shorting opportunity. These are incorrect. This should say stop loss. This should say entry, okay? And that's our target. Same thing here, guys. Clear, we have a base breakdown, curling 20-day moving average pointing lower. Really nice breakdown here. Huge drop, right? We see clear acceleration. There's clear extension from the 20 in price. We get a bottoming tail suggesting the buyers have taken control. The 20-day moving average is our first target. Huge volume spikes up here showing a reversal. This is a really, really nice setup here. We play it long. Entry here, stop loss here. Let's look at, I think you guys have seen this before in our other classes. Several setups here. We have a breakdown, right? Under this base breakdown with a 1, 2, 3, 4 pattern. 1, 2, 3, 4 setup. We drop, clear acceleration, clear extension, huge volume spike indicating a reversal. First target is the 20-day moving average, and this actually formed a sell setup. Okay, this formed a sell setup, and then we ended up going lower. Okay, same thing here. What happened here is we have a rising 20-day moving average. We the acceleration wasn't very clear, but it is sort of climactic because the 20-day moving average started, the slope was pretty huge. Rallied. We got a double top, making a higher low right here. And boom, nice setup here as well. Same thing here. We dropped into the 200-day moving average in this case on large volume. Okay. Reversal setup. Boom. So guys, let's talk about multiple time frames for the setup. Using multiple time frames is key. And why is it key? Well, if you don't have a clear entry on the time frame you're looking at, you should shift to a lower time frame. And you can even go down to the 1 or 2 minute charts for a potential entry. Okay? So let's kind of talk about this. Let's go to an example. Let's look at this example. You might be saying to yourself, "Hey, I understand this setup, but one thing I don't understand is we talked about entry bars, right? How we want entry bars, but on a lot of these setups, like for example, this is not a great entry bar. This is a huge topping tail, right? If our entry is over here and our stop loss is over all the way up here, that's a huge stop size." And you might be thinking, there's no entry bar here. Like there's a topping tail, but this is not a small bar like this. So in those scenarios, let's say we're looking at the 15-minute chart here, right? This is the 15-minute chart. If you see something like this on the 15-minute chart and you're saying to yourself, I want to play this, but I need a better entry bar. What you would do is you would drop to the 5-minute time frame or the 1-minute time frame or the 2-minute time frame and see if you can spot a potential entry bar. And then, play the setup off the lower time frames, wherever you could find an entry bar. However, always place your stop loss over the absolute highs or absolute lows of the move. Hopefully that makes sense though, right? So let's take a look at this example. You can see we don't have an entry bar, right? Our entry's here, stop loss is here, but in this case, go to a smaller time frame and see if you could spot an entry bar off the lower time frame, okay? And if you can't, then you're just gonna, and you really still like the setup despite it not having an entry bar, then you're gonna have to just have a larger stop loss than you want to. You could even just, sometimes when they move really fast and I can't find an entry bar, I'll just short it right here, right? And I'll just place my stop loss above the highs, right? Like you could even do that. And it's technically not a textbook, but let's say you're over here. You could just, and you think this is the reversals coming, just buy it. Calculate your risk, make sure you're not risking too much, buy it wherever, and just place your stop loss underneath the lows. And if it hits the lows and continues lower, well, you're gonna be already out of the position. Okay, so you could do that as well. Same thing here. We have a large entry bar. Go to the smaller time frames and try to find a better entry bar, a better entry into the trade. Okay, so hopefully that makes sense. And looking at the climactic and exhaustion pattern, something to note here: if the daily chart and the intraday charts are both climactic, meaning let's say on the daily chart, you also see that there's clear extension, there's clear acceleration, right? And on the lower time frames, right? Like for example, on the 15-minute chart or on the hourly chart, you're also seeing that that there's acceleration, we have extension, right? And if both the daily and the intraday timeframes are both exhausted and climactic, that makes a much more potent setup, right? Because all of the timeframes are climactic, all of them are exhausted, and that setup has a much higher likelihood of working out. Okay, hopefully that makes sense. Hopefully you guys understand what I mean about the multiple time frames. I'm trying to think if there's anything else I want to mention with this setup. So yeah, guys, this is a difficult setup, but it's really not that hard if you think about it. There's not that many, requirements we need. We need acceleration. That's pretty easy. Extension, pretty easy as well. Just distance. And just make sure you're following all of these qualities. Make sure you're looking at several time frames. Don't make the mistake of just finding a gradual uptrend and just shorting that. That's not correct. You need that extension. You need that acceleration. You need, hopefully, ideally, you also need the volume spike as well. This could work on the smaller time frames for scalps as well, for 1 or 2 minute time frames if you're scalping, or 5 minute. So let's look for scalping, swing trading, whatever, doesn't matter. I will say one thing, guys, before I forget, and there was this example. So I see this mistake a lot. Let's say you have a climactic move, that we have that acceleration, we have that extension, right? Usually the first sell setups after that move, right, we drop. Remember, a sell setup is when we retrace back to the 20-day moving average, right? And then we short it again. Usually, whenever you have a sell setup, after a huge drop like this, they usually never work. Okay, so let me kind of paint that out on here real quick. Let's say we have a huge drop, climactic drop, and then we retrace. This, shorting this position right here, right, doesn't work. Don't do this. It worked right here, but this is an anomaly. It usually never works. Okay, so if we have that climactic drop, right, we have that acceleration, that extension, the volume spike that we talked about. It's a clear climactic pattern, and you buy it, let's say down here, right? Right, remember our first target is the 20-day moving average. So let's change this color. Let's make this white. Let's say, it got to the 20-day moving average. I know it's kind of sloppy, but that's the 20, right? And you took profits off this long. You bought it here and you took profits there. Don't short it, right? Because this rarely ends up continuing lower. This usually fails. And let me show you what that looks like going long. Let's say you have a climactic long, right? Where a huge increase. We have literally picture this, right? We have that here, okay? And you decide to short it up here, right? You're shorting it up here, and it drops in your favor. Right, and remember the target is what? The 20-day. The target is the 20-day moving average. So let's say that's white. And you go, remember that that's where our target is too, the 20-day moving average. You took profits right there. This is technically a buy setup, right? Because we're retracing to the rising 20-day moving average. This doesn't work. This buy setup after a climactic move does not work, right? You could see it here. We had a climactic move higher. We dropped. we retraced, right, technically to the 20-day moving average. The first buy setup after a climactic rally usually doesn't work. You could see tried to move up and it failed. Okay. Let's see if we could find another. So this is an anomaly, it working here. Let me see if I can find another example. Like here, right? We have this is technically a sell setup, right? We buy it down here, right? Climactic, retrace to the 20-day moving average. This is a sell setup. You could see the sell setup did not work. We ended up continuing higher. Same thing right here. A lot of people are going to go ahead and buy this and be like, okay, we have a rally. We have a pullback into the rising 20. This is a buy setup. But remember, buy setups after climactic moves like this, where we have that extension, they never work. And this ended up failing. Okay, same thing here. Technically, over right here is a buy setup. These don't work. So in summary, after a climactic rally, where after exhaustion or climactic rally or a climactic or exhausted drop, and we get that retracement to the 20-day moving average here or the 20-day moving average here, this sell setup doesn't work. And this buy setup never works. So never take buy or sell setups after exhausted or climactic patterns. Okay, that's basically the last point I wanted to make. Now you guys should be able to also play reversal patterns and understand what to look for specifically. Remember, multiple time frames is key. And that's basically all I wanted to talk about, guys. So thanks. See you in the next class.
This next chapter is all about risk management, and risk management is by far the most important skill set that you can have as a trader. So make sure you're paying attention, because it doesn't matter how much money you make. If you don't learn how to protect your capital and how to limit your losses, you'll never become a profitable trader. So in this chapter, I'm going to teach you how to adopt a risk manager mindset. So let's hop right into it.
What is going on, guys? Hope you're having a great day. Today we are going to start with the risk management section of the course, and this is going to be a very exciting lesson, and let's just hop right into it. Okay, so risk management, this is truly a key to your trading success. There isn't a single successful trader out there that doesn't know how to manage his or her risk. Okay, I don't care if you're able to find the best trading setups, you're able to find the best breakouts, the best buy setups, right? You're able to read charts perfectly. The fact is, if you can't manage your risk, you're never going to succeed, okay? So make sure you really pay attention to this. So why does it matter? Like I just mentioned, it doesn't matter even how much money you make, right? It doesn't matter how many winning trades you have. If you can't manage your risk and limit your losses, you're never going to succeed, okay? And let me kind of give you guys a story of my personal trading journey. I remember when I first started trading, my father, of course, he's a professional trader, so he was the one that was mentoring me in the beginning. And he told me, your first goal in trading shouldn't be to make money. Right? And that sounds kind of crazy. Like we're that's why we're doing this. We're here to make money. But he said, no, your first goal should be to break even consistently. Because by breaking even consistently, what does that mean? That means you're not losing money consistently, right? And once you're able to limit your losses and be able to not lose money every single day, you're already 80% there to actually making money, okay? So the goal here, your first priority as a trader is, how can I manage my risk? How can I limit my losses? The wins and the profits will come, but make sure at first you really take care of your risk. That's what you want to focus on. The last thing that you want to do as a beginner trader is start trading in the markets, and because of your inability to manage your risk, you end up blowing up your entire account before you even gain any sort of experience, right? So your win rate does not have to be very high to make money. a lot of people talk about, oh, I have such a high win rate. Oh, I win 80% of my trades. That's great. You could have a high win rate and lose money, believe it or not. And you really don't need a high win rate to make money. Okay, and we're going to talk about that later. Your first thought when you enter a trade, and this is what your thought process has to be, your first thought should not be, how much money can I make off this trade? How much can I profit? How lucrative can this be? No, that's not the mindset that you want to have. The mindset you want to have is, how much can I lose if this trade does not work out, right? If this trade hits my stop loss, how much am I going to lose, right? And if you enter every trade with that mindset, with how much am I actually going to lose if it doesn't work out, you're going to immediately start limiting your losses. And a lot of risk management, it's not really something you can physically do. It's not about physically finding setups or looking at the quality of certain trading setups. No, it's more about discipline. It's more about the mindset that you have. And you're going to notice that the road to profitability, right? You don't need to make more money to become more profitable. That's one way to become more profitable, is to make more money. But you can also be more profitable by limiting your losses. So just like you should be focusing on, making money on your trades, you should devote equal, mind space towards, figuring out, how do I limit my losses on all of these trades, okay? So number one, the first step that you have to do, is determine your risk. Sit down on your bed or wherever you want and think about, what is the maximum amount of money I am willing to lose per trade, okay? And what I mean by maximum amount of money you're willing to lose per trade, specifically, how much money can you lose without being psychologically or emotionally affected, right? Like, for example, for me, I usually risk anywhere between $100 and $300 per trade, maybe a little more sometimes, right? If I lose $100, I'm not worrying about the next trade, right? That doesn't hurt me psychologically. I accepted that I'm okay with losing $100, and when, let's say, that loss occurs, when I do lose the 100, it doesn't affect me, right? It doesn't affect my psychology or my disposition. It doesn't make me make emotional decisions. But let's say, for example, if I lost $1,000, well, that's going to make me feel uncomfortable, right? That's going to make me feel a little emotional because I'm not really prepared emotionally and psychologically to lose that much money, right? And that sort of loss is going to affect my trading. It's going to affect my psychology. And maybe, you guys have taken a few trades, and if you've noticed, after some of your losses, you begin to, think, you're not thinking rationally anymore. Now you're starting to think emotionally. You're starting to think, oh, I have to make back that money that I lost. I can't believe I lost that much. Oh, and you start, making bad decisions. That's not what you want to do. You want to risk the exact amount that you're comfortable with risking, where if you lose that amount, it's no big deal, right? If you lose, like, for me, if I lose $100, it's fine. I'm not worried about it. Big deal. It's okay. But if you're a beginner, right, and you don't know what risk you should go with, start with $10 or $20. I don't even care if you have thousands of dollars to trade with. You might have a $25,000 account, and I'll still recommend you to start with $10 to $20 risk, or maybe even less. Start with $5, right? Because in the beginning, right, your goal isn't to make money. It's to develop consistency and perfect your trading plan, and the money will come afterwards, okay? So stop worrying about the money. I can tell you right now, if you're just starting to trade and you're taking this seriously, if your goal is to make money right away on the first couple trading days, it's not going to happen. Focus on the consistency in perfecting your plan, right? And practice. Don't worry about the money. And in general, if you're a beginner, you guys should be paper trading anyway. But this class is more about, once you're done paper trading and you're going into trading real money, okay? Because with real money comes real emotions, comes real human psychology, right? And your risk should be the absolute highest amount you're willing to lose per trade. If your risk is $100 per trade, the maximum amount you could lose is $100, okay? So let's say you've determined your risk. Let's say for our sake, it's $20, okay? That's our risk. Actually, no, let's not do $20. Let's do $100. Our risk is $100 because that's what we're using in this example. Your strategy should be this. On every single trade that you take, right? If you're risking $100, you have to make sure, or you have to pick trades that give you the opportunity to make at least $200 or more, right? So if our risk unit, our R is $100, your return to risk has to be 2 to 1. 2 R's to 1 R, right? 2 R's is $200. 1 R is $100, right? So step one, figure out your entry price, right? Whether it's a base breakout, a buy setup, a breakdown, a climactic pattern or exhaustion play, or a sell setup, or a 1, 2, 3. You guys should know how to find your entries for each one of those setups by now. Find your entry price. Number 2, find your stop loss price, right? You guys should be able to know how to do that as well by now. And step 3, figure out your target price. And we're going to have classes in the course talking about figuring out your target price. And it usually comes down to checking your next resistance or support levels, okay? And step 4, ask yourself, based on my entry and the size of my stop loss and the next target, right? Your target price, is there 2 to 1 return on risk, right? Do I have the potential to make at least twice the amount that I am risking? Okay. And if yes, then go ahead and take the trade. And if it's a no, then pass on the trade, right? If this only if you find a trade and you're seeing that it only really has the potential to make you $100, well, why would you risk $100 to make $100? That doesn't make sense. We want to risk $100 to make $200 or $300 or $400. And over time, if you keep taking setups that give you at least 2 to 1 risk to reward, you're going to notice that you don't need a high win rate to make money. So let's say we take 10 trades and only 4 of these trades are winning trades, right? If you're following this risk management strategy where you're making at least 2 to 1 return on risk, right? If you're winning trades make 2x what you're risking, you're going to make money, okay? So we have our first 6 trades, let's say, they're all losing trades, right? And we know that our risk is $100. So we lose the maximum amount that we can per trade, which is $100. So we lose 100, 100, 100, 100, 100, 100, right? We're down 600. But then we have 4 winning trades that make us at least 2 to 1 return on risk. So we make 200 on 4. What's our profit? Well, it's going to be 800 minus 600. We have a profit of $200, right? So even with a 40% win rate, as long as you're following this strategy, you're going to make money, okay? And imagine some of these winners, right? Like we talked about 2 to 1 return on risk. What if some of your winners are actually, huge winners, right? Let's say you make 3 to 1. Let's say this is a $300 trade. This is a $300 trade, right? Then that's when you see your profits go up, up, and up. But the point here, guys, is as long as you're making 2x on your winning trades and then on your losing trades, right, then you're going to make money even if you don't have a high win rate, even if you're not winning 60% of your trades, okay? Hopefully that makes sense. So keys to understanding risk management. It's important to understand how to share size. Your share size depends on the size of your stop loss. You guys should already have some experience, looking at and understanding share size through our strategy videos, right? But to remind you guys, share size equals your risk, right? Your dollar amount risk divided by the size of your stop loss, okay? So let's give an example. Let's say your risk is $100. Your entry price is $6. Your stop loss price is at $5.90. Let's say this is a breakout, right? It's a 10-cent stop. Your stop size equals 6 minus $5.90. That means the size of your stop is 10 cents. Let's say your target price is $6.40, right? How many shares should you buy to ensure you don't lose more than $100? How many shares should you buy? Well, if you're risking 10 cents, right, you don't want to lose more than 100. Well, that's 100 divided by 10 cents. You're going to be buying 1,000 shares. That's how many shares you can buy. At the end of the day, if you oversize your position and you buy or you short more shares than you want to, if that position becomes a loser, you're going to end up losing way more than you want to. That's why share sizing is so important to risk management. So make sure before every trade you take, calculate the correct amount of shares. Okay, make sure you calculate the correct amount of shares so you don't end up losing more than you want to. One simple mistake, and you buying more shares than you wanting to, you're going to end up losing way more money than you want to, and then that's going to affect your trading psychology. We also have the percentage approach where, let's say you have $1,000 portfolio and you decide to risk 5% of your account per trade, right? So 5% of your account per trade. That's just an example. Usually maybe it should even be 2 to 3%, but let's say you decide to risk 5% just to make it easier for us. How many shares should you get per position? Well, $1,000 portfolio, you're risking 5% of it. Let's find the dollar amount. 1,000 times 5%, 0.05 equals $50. So $50 is the amount that you're willing to risk, right? That's 5% of $1,000, right? Then your share sizing is going to be your risk, $50 divided by the size of our stop. Let's say for this example, the size of our stop is 5 cents. $50 divided by 5 cents, you're going to end up getting 1,000 shares. And if you're curious, how do we know the size of our stop? Well, that's why, when you're picking your trading setups, whether it's a buy setup or a sell setup or a breakout, you're going to know the exact entry, the exact stop loss. And then stop size equals entry price minus stop loss price. Okay, golden rule. Here's a golden rule. When you are in doubt, lower your risk. If you're in doubt, lower your risk. If you're not feeling comfortable, lower your risk. Okay. It never hurts to lower your risk. If something is going on, if you're not feeling yourself, if you're kind of compromised psychologically, just lower your risk. Okay, that's a golden rule. Okay, if things aren't going well, lower your risk. You guys get the idea. Whenever there's anything that's going bad in trading, the last thing you want to do is have a huge loss. So lower your risk. That's what I personally do. Sometimes when I have a few losing trades in a row, what do? I lower my risk. Keys to success here. As you guys know, the tighter the stop loss, the better reward to risk. So that's why you want to find trades that have tight patterns, that have tight stop losses. At the end of the day, guys, risk management is all about discipline. Everything that I taught you today, this isn't anything that difficult. It's nothing that you have to, aside from maybe that formula. But none of this stuff is difficult. This is all just discipline, making sure that you're disciplined with your stops, you're disciplined with your risk, and just always keep in mind that, you don't want to take on bad losers. Okay, so be disciplined when it comes to your risk. Make sure you're never oversizing your positions. And by limiting your losses through risk management, you will become more profitable. We talked about that. And guys, just understand, now that you guys are traders, you're also risk managers. You are managing the risk of your personal account. Okay. And we talked about the psychological aspect of it, but if you're not comfortable with losing X amount per trade, what's the golden rule? Lower your risk. If you're feeling sad or uncomfortable after taking a trade, golden rule, lower your risk. Losses can emotionally and psychologically affect you. Don't let your need to make money affect the amount you risk. I understand you want to make money. We all want to make money. We all want to profit. But don't let that need to win and that need to be profitable end up being your downfall. because that might happen, okay? And you're going to become profitable and more. You're going to make more and more money over time, okay? Understand this might take time, okay? But that shouldn't discourage you. Anything in life that's, makes money or that's worth anything, it usually takes time to acquire those skills or to acquire that accomplishment. So understand that this is all going to take time. It's not a problem. You will become profitable over time as long as you manage your risk and you don't blow your account on some stupid trade because you completely oversized your position, okay? And understand that as a trader, your psychology and your confidence is everything. Taking bad losses for no reasons will affect you. I can tell you that personally. It will affect your confidence. And without your confidence, without that psychological composure, you're not going to be able to take advantage of really good trades. Okay, so please, guys, manage your risk. Be disciplined with it. Don't, try to go for huge winners. Always think about how much money can I lose if this doesn't work out. Okay, and that's really it for risk management. I might include another little motivational risk management clip, but that should make sense, guys. Let me know if you have any questions. Thanks a lot. Hey guys, how's it going? Thanks for tuning into this video. The whole topic of this video is going to be share sizing. How many shares should you be purchasing per trade? And before I go into it, this concept is very important. It is a critical part of managing your risk. If you guys end up buying too many shares on a trade, you're going to end up losing, way more money than you intended to if the trade goes south. Of course, on the flip side, you're probably going to make way more than you intended to if the trade, ends up working out. However, share sizing, it's important because you need to minimize your risk and you need to buy or short the amount of shares that you're comfortable with, because trading is not really about how much money can you make. Of course, we're all in the game to make money, but a critical question really is how much money are you willing to lose? Okay, managing your risk is probably one of the most, if not the most important, elements of trading. Okay, and share sizing is a huge factor in that. So let's get right into it. Step one, and before I actually go into the steps, it's extremely simple. This is something, if you guys know basic math, which all of you do, this is extremely simple. All right. Step one, you're going to want to ask yourself, what is the maximum amount, dollar amount I am willing to lose on this trade? So if you're comfortable with losing $100 per trade, then that's your answer. It's whatever you're comfortable with. Personally, I do anywhere from 100 to 300. Sometimes I risk a little bit more depending on how I'm feeling, or depending where my confidence is at, but that is what I'm comfortable with. That is known as your risk for the trade, okay? So ask yourself, what am I comfortable with losing, and figure that number out. And the whole idea behind this is that if you lose more than you're comfortable with losing, then that's going to affect you psychologically. It's going to, hurt your psyche in a way. It's going to make you feel uncomfortable. It's going to be like, wow, I lost way more than I wanted to. It's going to hurt your confidence. You don't want that to happen. When you have a losing trade, it shouldn't affect you. And the key to that is you have to make sure you're losing the amount that you're willing to lose, or that you can lose, that you're comfortable with losing. Step two, calculate the size of your stop loss for the trade. Some examples is a 10-cent stop or a dollar stop, etc. And in order to correctly identify the stop loss for the trade, you have to make sure you know exactly what strategy you're playing. Different strategies call for different stop losses, or different stop loss placement, I should say. So I would definitely look into the buy setup, which is a video that's posted in the server, the breakout, another video posted in the server, and the 1-2-3 pattern. I don't think I posted that yet. However, I'm going to do a class on that shortly. Okay. And make sure you know what strategy you're playing, because if you know what strategy you're playing, you know exactly where to put your stop loss. So that won't be an issue. In step three, you're going to apply the formula. What is the formula I'm talking about? It's really simple. It's share size equals your risk divided by your stop loss. Okay, so whenever you are going into a trade, I don't care if it's equities or crypto or Forex, and you're buying shares or you're buying cryptos, you have to ask yourself, what's my share size going to be? Okay? And it's really simple. Let's say your risk is $200. That's the most you're willing to lose on this trade. And your stop loss happens to be, you calculate it, it's 10 cents. Then you do $200 divided by 10 cents equals 2,000 shares. So there you go. You know exactly how many shares to buy. And if you buy, let's say, those 2,000 shares and the stock does hit your stop loss, meaning, it doesn't work and the trade doesn't work in your favor and it drops by 10 cents, the most you're going to lose is $200, which is the number you agreed. You kind of made an agreement with yourself that that's the most you're willing to lose. Okay, you lost it, but at least you're comfortable with losing that amount. Same thing here. Your risk is $100. Your stop loss is $1. Risk divided by stop loss, $100 divided by $1 is 100 shares. So if you buy it, right, 100 shares, if it drops $1, you're gonna lose $100. And it drops $1, you're gonna lose $100. Okay, it's super simple, guys. Again, share size equals risk divided by stop loss. And I'm to the point, where this is kind of automatic in my head. I'm automatically doing the math every time I'm looking or considering a trade. I'm just immediately doing this calculation in my head to really figure out what my stop loss, or not what my stop loss, what my share sizing is going to be. Because again, I personally don't want to lose more money than I'm willing to on that trade. That's why share sizing is extremely important. It's a critical part of risk management. And guys, never buy or short more shares than you're comfortable with doing. Because trust me, if it doesn't work out and the trade goes south, it will psychologically affect you. Okay, well, not only that, it might just drain your account. You might lose way more than you intended to. But anyway, guys, let me know if you have any questions about this concept. It's super simple, and the formula is super simple, but it's extremely, extremely important. Please direct message me, Emmanuel Trades, or type in the premium chat tagging my name if you have any questions regarding share sizing. Thanks, guys, and have a good day.
Videos. So when my father began mentoring me 5 years ago on how to trade, this was quite literally the first thing that he taught me. He told me that this should be the backbone behind my trading, and that's exactly what it is today. And this is the reason I'm a successful trader today. And this is more than just a rule. This is a mindset. And a lot of you guys watching this video may listen to this video and kind of blow past it. Kind of, oh, whatever, yeah, I know that. But you need to take this to heart. You need to instill this way of thinking into your trading and into your analysis. And I guarantee you, it's going to end up making you more money. And this rule is incredibly simple. When in doubt, lower your risk, right? It's not sexy. It's not this crazy new indicator. But whenever you are feeling uncertainty, stress, high emotions, lack of confidence, whenever you're feeling anything that is negative in your trading, you need to lower your risk. When in doubt, just lower your risk. Because 80% of your trading success isn't going to come from price action or knowing the right indicators or knowing how to read patterns. It's going to come from your ability to handle your emotions, handle your psychology, and of course, manage your risk. And your emotions and your psychology are very directly correlated with your risk. So if you are feeling emotional, if you're feeling anything that is remotely negative, you're starting to feel doubt, you need to lower your risk. And this has saved me so much money in my career, having this risk management type of mindset where I go into trading, I go into every setup that I take. In my mind, I'm not thinking, oh, how much am I going to make off this setup? Oh, I might make 1,000 to 2,000 and perfect. That's going to put me up 10K in the week. Amazing. No, when I go into a setup, I'm thinking, what is my downside here? Like if this thing goes against me and hits my stop, how much am I going to lose? How volatile is this stock? Is there a high probability this stock is going to actually blow past my stop and I'm going to lose more money, I always think of the downside first. I always try to protect my capital. And that's what you need to understand as a trader. Your priority isn't to make money as a trader. Your first priority is to preserve the capital in your account, capital preservation. Your second priority is to make money on that capital, to make money on the, capital you have in your account. That's your second priority. First is capital preservation. And most traders, unfortunately, don't have this mindset. Most traders don't really care about their bottom line or their downside. They just care about making money. They just care about quitting their job, living this life of freedom. And yeah, those are some of the best perks when it comes to trading, but you'll never realize them unless you adopt this risk management mindset. And there's a very common cycle that most traders go through here. And I kind of drew up a little rough representation here, but a lot of times a trader will make a mistake. Maybe it's an honest mistake. Maybe you under-risked on a trade, or you over-risked on a trade, or you messed up your management, or you took the wrong trade, maybe you FOMO'd in, whatever. You make a mistake. What does that lead to a lot of the times? An emotional crash out, right? And guys, we are not robots, right? Like, I hate this advice that you constantly hear on the internet that's like, oh, if you're a trader, you have to trade like a robot. You have to trade like an algorithm. Bro, we are human beings. We feel emotions. Unless you're like a psychopath, you feel emotions. And especially in trading, those emotions are strong. They're almost violent, where a lot of the times, we sometimes feel like completely different people when we trade. Like, we go into the trading day feeling composed, feeling good, ready to follow our plan. And then as soon as the market opens and you begin trading, right, things happen, prices move, you lose money, you make money, and that changes your psychology, changes your emotions. And next thing you know, right, if you make a bad mistake or two, you're having a full-on crash out. You're getting emotional. You're starting to sweat. You have that psychological pressure, right? And this happens to a lot of traders. Maybe it doesn't happen to you every day, but maybe, let's say, once or twice a month, you have this sort of emotional crash out. Now, my biggest suggestion, honestly, is to just step away from your desk. But that's hard for a lot of people, right? Let's be real. It's going to be difficult for a lot of you guys to step away from your desk, but the least you can do is decrease your risk. But unfortunately, what most people end up doing is they have this crash out, right? And they're like, oh my God, I have to make back the money that I just lost. Oh, I was up 1,000, now I'm only up 200. I have to make that back, right? What do? They increase their risk. And as soon as they increase their risk, they have this mindset of, I need to make money, right? It's ultimately greed. That's what's causing this. You're increasing your risk because of greed. And greed is what's stopping you from making money in the first place. Isn't that ironic? Greed is our desire to make money. Your desire to make money is what's stopping you from making money. So you increase your risk, and what happens? You take another trade and you end up losing money, right? Because you over-risked, or maybe from there you took a low quality C+ setup, maybe a D setup, and you end up losing more money because you increased your risk. And that usually leads to another emotional crash out, or you making even more mistakes. And this is how the cycle begins. And the thing is, you only have to go through one of these cycles to ruin months of progress. You could be perfectly trading according to your plan for 2 months, managing your emotions, and you have one day where this happens, where you have this crash out, everything's going wrong, and all of a sudden you increase your risk. Now you're losing money, and you're giving back months of profits, months of progress. And some traders even just blow their entire account. And this is just the unfortunate reality of most traders. This is what happens. And you need to avoid this at all costs. And ideally, you just decrease your risk when this happens, right? So the real cycle should actually be, you make a mistake, you have that emotional crash out. That's fine. Sometimes I get frustrated too. It's a part of trading. From there, you lower your risk, or you just step away in the first place. Well, let's say you don't step away. Lower your risk. And from there, you can rebuild your confidence, right? You take trades with smaller risk, right? then let's say those end up being winners. Yeah, it's still on small risk, but you're rebuilding your confidence. And once you're back to like, okay, I'm feeling myself, I'm feeling good, right? I'm not emotionally unstable anymore. I'm feeling great. Maybe 1 to 2 days later, after you've rebuilt the confidence, you're able to re-raise your risk to where it was originally. And from there, even if a mistake happens, right? Maybe even if you get emotional, you have like a protocol ready where you're ensuring that you're not going to lose a lot of money in your account. You're protecting yourself, right? You have a protection protocol where you decrease your risk when you find yourself feeling doubt or uncertainty or stress, high emotions, or lack of confidence, any one of those things. So before I go over some key situations that I guarantee you have faced as a trader and show you how to actually apply this rule in practice in the moment, I want to talk about the risk management formula. And it blows my mind that people don't know how to calculate this. They don't know how to size their positions. And I'm going to show you by how much you should decrease your risk by if you are feeling doubt or uncertainty. So right off the bat, before we enter any single trade, our risk is predetermined. We don't go into a trade not knowing how much we're going to lose if the trade hits your stop loss. We go into the trade knowing that if it hits our stop at this specific price, I'm losing X amount. That risk is predetermined. As a result, you need to size your positions correctly. So if the trade does hit your stop, you're only losing your predetermined risk. And your sizing is like your share size or your lot size, right? And the formula for this is really, really simple. It's risk, your dollar risk, divided by entry price minus stop loss price, right? So let's say you on average risk $500 per trade. And let's say the entry price for that trade is $3, right? Let's say you take like a breakout opportunity, entry is at $3, stop loss is below the base is at $2.90. Great. So if it hits your entry at $3, you get into the trade. And if the trade goes back down and hits your stop loss at $2.90, you exit and you get stopped out. Now, you need to buy an appropriate amount of shares to make sure that if it does hit your stop, you're only losing $500. And this is the reason why we use this formula. So you take the entry price, you put it here, stop loss price, you put it in here, and then $500, which is your risk, is divided by that. So $3 minus $2.90 is 10 cents. 500 divided by 10 cents is 5,000 shares. So if you get 5K shares at $3 and then it stops you out at $2.90, you're going to lose $500. It's very important that you do this calculation before any trade that you take. I have to include it in this video because it's crucial. You have to do it. It's not optional, right? And let's say you're starting to feel uncertainty. What you can do is you lower this risk amount from, let's say, from 500, and let's actually type it. Let's say from 500, you're feeling uncertain. You're not feeling good about your trading. You're like, you know what? I want to decrease my risk. I'm going to decrease it by half. So now it's $250. Great. These numbers don't change, but your risk changes. And as a result, your share size changes as well. So now you're getting less size for your positions, right? Your share size is decreased because your risk has decreased. And I recommend doing it maybe by half or by 60%. It depends honestly how you're feeling. This is more discretionary. It's up to you how much you want to decrease your risk by. But I recommend half if you're feeling really, really down on yourself and you're just not trading the way that you know how to trade and you're just feeling off, lower your risk by half, okay? Now let's talk about some key situations where this could be truly, truly applied. So let's kind of go over it here. So there's a bunch of situations. We'll start off going through kind of the first one here. So let's say you're up $1,000 on the day. You're feeling good. You see another quality setup. You want to make another 500 to 1,000 on the day, right? So let's say it's lunchtime. You're up $1,000, feeling great. You traded well. You see another really nice setup, and you're like, hey, I think I can make 1,500 to 2,000 bucks today. I'm feeling good. Let's make some money, right? You're feeling pumped up. Then all of a sudden, you completely mess up that setup, and instead you end up losing $200. And now you're at $800 for the day. right? Let's say $200 is your predetermined risk. So you lost your predetermined risk, everything's fine, but now you're like, I was up 1,000, now I'm up only 800. Maybe that $1,000 is like a psychological level that you want to see your profits above 1,000. You're like, no, I need to get back up above 1,000. And what you do is you raise your risk, you end up over trading, and then you finish the day in the negative. So what went from a nice, solid $1,000 day, you take a trade, you lose your risk, you're only up 800 now, and you're like, no, I need to be up more than 1,000. You overtrade, you lose your confidence, you increase your risk, and as a result, you give back everything. I guarantee this has happened to you, and you need to avoid this, right? And general rule of thumb is always protect 70 to 80% of your profits in a trade, right? So if you're up 1,000, you need to at least finish the day up 700 to 800, okay? General rule of thumb. This is a great situation. So maybe when you're up 1,000 and you're like, okay, I'm good here, I'm feeling good, I want to make sure I finish above 1,000, lower your risk for the rest of the day. If you're feeling like you're good with your profits, right? Now, if you do see a really high quality trade that's like A+, sure, use your regular risk. I'm not saying don't do that, but I'm saying lowering your risk could be a good solution for you to make sure you're not giving back too much. Next, let's say you take 3 really nice high quality setups and lose. You take 3 good setups that fit your plan, but they lose you money. Now you're starting to feel emotional and frustrated. You increase your risk, and next thing you know, you're down 5, 6, 7 Rs, right? You don't want to do that, right? You don't want to do that. If you take 3 high quality trades in a row, you're following your plan, you're taking the right setups and they lose, that's fine. That's going to happen sometimes. The worst thing you could do from here is raise your risk to try to make back what you lost, right? If you are feeling a little bit uncertain and frustrated after 3 losses, lower your risk, rebuild confidence, and then raise your risk back up. Or if you have a 3-day losing streak, you're down 3 days in a row, maybe it's your fault, maybe it isn't, maybe it's a tough environment, maybe there's other external factors in your life that's stopping you from trading to the best of your ability. It could be for any reason. If you have a 3-day losing streak, I don't care what the reason is, lower your risk. Hands down, lower your risk by 50 to 70%. Or it's a heavy news day and there's, crazy things going on in the market. Markets are really volatile. The market might be changing, right? The environment might be changing. This happens a lot to a lot of new traders where they make a bit of money 3, 4, 5 months, and then the market kind of switches and they fail to adapt, right? Or maybe it goes from a bullish market to a bearish market, or a bearish market to a sideways market, and traders fail to adapt. And the same strategies that they were making money on before, they're not making money on those strategies anymore. And next thing you know, they're feeling frustrated. They're feeling nothing is working. They increase their risk. They try to make their money back and they blow their entire account, right? If you're noticing that's a weird day in the market, heavy news day, the market is adapting, decrease your risk, find comfort in that market, start to develop confidence in that market. And once you're feeling good, increase your risk back to the normal amount. Or guys, honestly, maybe you're trading in a new location. Like I was traveling in Europe this past month. It was I was in the hotel rooms with a different monitor than I'm used to. The Wi-Fi was a little bit weird. Different location, different setting. I'm trading now in the afternoons versus the morning. That kind of affects you as a trader. I'm a creature of habit. I like consistency. I like having a structured day. And when I was trading a little bit in Europe, I traded a couple days per week, honestly, just for my students. It was weird. So what did I do? I decreased my risk until I felt comfortable enough to increase it back to the normal amount, considering my environment changed, okay? Hopefully this makes sense, guys. And the reason this is so important, guys, genuinely, most people think that you need new strategies, you need a new methodology, you need new indicators, you need much higher reward to risk to make more money. And that couldn't be farther from the truth. The easiest way, nothing is easy in trading, I'm saying the simplest way to make more money is to simply limit the amount that you lose. And the way that I came up with this number right here, 378,000, is this, right? There's 252 trading days per year, I believe, somewhere around there. I've been trading for 5 years. Call it give or take 1,200 trading days. It's a nice round number. If I'm able to have this mindset and this rule of lowering my risk when I'm in doubt, or just having that risk management mindset, like just living my life being fiscally conservative and being conservative with my trading, just having this overall mindset of worrying about my downside over my upside, if that can save me an extra $300 per day, I'm going to make an extra $378,000 over 5 years. That's an extra $75K a year, guys, by doing nothing but adopting this mindset. It's the only thing I changed. Risk management mindset and having this rule. If this rule saves me $200 to $300 per day for the rest of my career, which I risk around $500 to trade, around there, between 300 to 700, I have more of like a range. If this is able to save me $200 to $300 a day, and that might be even conservative, right? It might even save me way more money. I'm making an extra $75K per year just because of that. Not by learning new strategies or trying out different things, new indicators. No, just by having this mindset, I'm making more money, right? By the end of the week and the month, if you're just able to limit your losses on your losing trades, you're going to make more money, right? And no one talks about this. Everyone talks about exciting new stuff in your trading, new whatever strategies and indicators like I mentioned, but no one talks about this. And this is how I've saved so much money in my career by just applying this rule and not getting so emotional and not increasing my risk and then losing all my money, right? When in doubt, lower your risk. I don't care, if you're not feeling good, frustrated, stressed, whatever. It could be because of reasons outside of your trading. Maybe you got into a fight with your spouse, or maybe someone upset you in your personal life. You're going into trading not feeling the best. Lower your risk, okay? Just trust me, just do it and rebuild that confidence and then re-raise your risk, okay? And yeah, make sure this is not your cycle, okay? So this is a nice little summary. Yeah, hopefully you understood the share sizing formula. And yeah, guys, use these situations, okay? When in doubt, lower your risk. Have that risk management mindset. This is what's made me a profitable trader. I haven't had a losing month in over 5 years. And that sounds crazy, but I'm happy to post my statements. I've done it many, many times on my channel and on my TikTok. I'm happy to be as transparent as possible. The reason I'm so consistent is because I have this mindset. All right, guys, that's it for the video. I hope you enjoyed. And if you need to help build your trading foundation, you need more help with risk management or your strategies or the way that I trade, I have a free 10+ hour course that is genuinely better than most paid courses on the internet. Seriously, any course you've ever taken, my free course will trump it. It's just significantly better. I know it is. So make sure you start watching it. It's in the description of this video. And it'll help build the foundation for your trading, and it'll teach you a lot more stuff. And it'll expand about everything that I talked about today. So start the free course. Let me know what you think of it. Watch my other YouTube videos in conjunction with that education. And yeah, leave a comment, leave a like, subscribe to the channel if you found this valuable. I will see you guys in the next video. Thank you so much for watching, and hopefully you'll take this to heart, and hopefully within weeks you can actually apply this, and as a result, make more money. I'll see you guys in the next video. Thank you. In this next chapter, I'm going to teach you how to combine everything you've learned in this free course so far with scanning and with trading gaps. And it's going to sound a little bit confusing in the beginning. Maybe you don't know what a gap is. However, you're about to learn it. This chapter is especially powerful because we're finally getting into the more practical side of how I scan and how I find high quality setups. So make sure you're paying attention, and let's hop right into this chapter. Change of scenery here. The hotel kicked me off the terrace because they knew about the value I was about to drop. But in this video, I'm going to explain what the gap trading model is, how it works, why it works, how to apply it within your own trading starting tomorrow, how to scan for these massive moves that I'm about to show you, and how to take advantage and trade those moves using predefined simple setups that even a beginner could take advantage of. And if you haven't realized it yet, I like to keep my trading as simple as possible. And this model is incredibly simple. It's not complicated. It's not complex. It's very easy to understand, as you're about to witness. But the real sauce is applying it correctly. There are details, there are nuances that are important to understand to find high probability trades on high momentum stocks, right? I, as a trader, pass on like 98% of the opportunities in the markets. I only focus on high probability, high quality. And you have to differentiate yourself from all of the other traders who take low quality setups. There's a lot of traders who trade gaps, who are kind of familiar with this model, but not a lot of them succeed because they focus on low quality gaps and low quality setups. But that kind of begs the question, what is a gap in the first place? So if you search up on Google, what is a gap in trading, you're going to get this definition. So feel free to pause the video and actually read this definition, but I'm going to simplify it even further. A gap is an overnight change in price. The stock market closes at 4 p.m. Eastern on weekdays, and it opens the next morning at 9:30 a.m. Eastern. So all of the price activity that happens overnight, whether it's buying or selling, that price activity is reflected the next morning as a gap. So let's say a stock closes at $5 at 4 p.m. Eastern on Tuesday, and then the next day on Wednesday, when the market opens at 9:30 a.m. Eastern, the stock opens at $8. That $3 difference in price is called a gap. So it's just an overnight change in price because there's trading activity that occurs either in the post market or the pre-market. And these gaps occur because of news, because of earnings within the company, like positive earnings or negative earnings, or events in the company, or maybe there was a new law that was passed where that affects the company. And as a result, investors either panic or they get really excited during the after hours trading, and that causes the stock to gap and change in price overnight. However, it's very important to understand that we don't care about the news. I'm not sitting there every morning and reading earnings reports or reading the news about why that stock gapped or why, the investors panicked. I don't care about any of that. All I care about is the price action. What effect does that gap have on the charts? So let's go ahead and look at some examples so you could literally visualize what a gap is, and you could literally see the gap in price on the chart. It's not really important where the price was for this example or what day this was. I'm just trying to prove a point here where we closed right here on the previous day, and then the next morning we opened up here, and you could literally see the gap in price on the chart. And that's exactly what a gap is. It's an overnight change in price. This was on J&J just a couple of weeks ago where we closed right here, and then the next morning we gapped down and we opened right here, right? You could literally see the gap in the chart. So we have gap ups and we also have gap downs, and these were pretty significant gaps. But take a look at this one. This one was actually a pretty small overnight change in price. And always remember, the amount that it gaps isn't really relevant. What we care about is where it's gapping to on the charts, and we're about to talk about that in just a second. But right here, we closed at this price the previous day, and then the next morning we gapped up right here. And like I said, you could literally see the gap on the charts, and it's really simple. A gap is just an overnight change in price. So before I teach you how to identify high quality gaps and how to trade them step by step, it's very important that I debunk a very common misconception and myth that I always see, that all gaps fill. And this is complete nonsense. A lot of traders will tell you this, but it is not true. And what a gap fill is essentially when the price of the stock returns to the price it was the previous day. So let's say a stock on Tuesday closes at $5 at 4 p.m. Eastern. And then the next morning on Wednesday, it opens at $8. A gap fill would be where the stock opens on Wednesday at $8 and then drops back to $5 and just goes back to the original price it was the previous day. So for example, like on J&J, we closed right here, and then the next morning we open here. This is the gap. A gap fill would be where when it opens on this day, it just goes back to the original price, right? Or for example, right, let's take it on Chegg right here. We closed here and then we opened here the next day. And instead of moving up, a gap fill would suggest that it would drop back down to this original price, essentially where it was the previous day. And that's what a lot of traders will tell you. They'll tell you that all gaps fill. and you shouldn't really focus on gaps because they all fill. But that is nonsense. And the reason I know that is because I trade gaps for a living. I do this every single day. I've done it every day for the last 5 years. And 90% of the time, I am looking to trade in the direction of the gap. I trade the continuation of the gap. So if it gaps up, I'm looking to go long. If it gaps down, I'm looking to go short. Now, there are exceptions to this where I'll go for the reversal, where if it gaps up, I'll be looking for a short, or if it gaps down, I'm looking for a long. But those are pretty rare. And yeah, it's like 5 to 10% of the time. 90% of the time, the majority, I am trading in the direction of the gap. And you might be wondering, why do I trade gaps in the first place? And it's very simple. Gapping stocks move way more than non-gapping stocks, and they just have way more momentum. And as a day trader, I want to trade stocks that have a high probability of moving 10, 20, 30, 40% in a single day. And the gap is like a catalyst for that stock. I like to trade stocks that have a catalyst because the catalyst causes it to just move way more than non-gapping stocks or stocks that don't have a catalyst, right? So it's very simple. Gapping stocks just have a higher probability of moving and having momentum in one direction. And they also provide me a clear bias in direction in which I should trade in, right? Where if it gaps up, I'm looking to go long. If it gaps down, I'm looking to go short. It gives me what the trend is. It gives me that bias in which I should be trading in. So let's get into how to trade gaps for a living step by step. And step number 1 is finding gaps in the pre-market. So every single morning at 8:30 a.m. Eastern, around 1 hour before the stock market opens, I begin my morning preparation where I go to my trading office and I begin scanning for gaps. And what you're essentially scanning for is percent change or percent difference between yesterday's closing price and today's opening price. And there are a bunch of different tools, scanners, websites that could actually help you accomplish this, and they're 100% free. And I'm also going to show you the specific site that I use every single day to scan for gaps. Now, the first website that you could use is finviz.com, and this is actually a really popular site for traders and investors, and I have used it in the past to scan for specific stocks. Now, I don't use Finviz for my current scanning right now. I just want to give you different options and different tools that you could play around with to see what you personally prefer. But don't worry, I'm going to show you exactly how I do my pre-market scanning to find gaps every single day in just a second. But once you're on finviz.com, and by the way, this is also a free site, so I want to show you free websites that you could use so you don't have to pay for anything, or you don't need to sign up for a specific brokerage that may or may not be available in your area. So once you're on finviz.com, just click on Screener right here, and it's going to bring you to this page. From there, navigate to technical, and if you click on right here, gap, if you kind of hover over it, it'll tell you the difference between yesterday's closing price and today's opening price. Now, it might not show today because it's Saturday. However, if you click on that, you could scan for all gap ups, or you could scan for all gap downs. Now, they also give you functionality of like specific percentages, but I don't see how that would be useful. I would just scan for all gap ups and all gap downs. The next site that is super useful is marketchameleon.com. And once you are on the site, you just hover over to stocks, and then you go to features, pre-market trading. Just click on that. And this website actually gives you a big list of overnight gap ups or overnight gap downs, where it gives you this list of gainers, percentage change, and it'll list them in descending order based on the biggest gap ups all the way to the smallest gap ups. And then for the decliners, the same exact thing. It gives you the biggest gap downs all the way to the smallest gap down. So you could literally just copy and paste these tickers onto your watch list every single morning. And there's other really cool functionality with this site. It'll give you the most active tickers traded that day. And sometimes I do kind of scroll through Market Chameleon during the intraday. For example, if I want to see like the top gainers on high volume, and I'll just kind of see what stocks are popping off that day. You could also use tradingview.com, where you head over to products, you go to screeners, and then you go to stocks. Now, I haven't actually used TradingView, so you guys could experiment and let me know if it works or not. But if you go to extended hours, it'll actually tell you pre-market change percentage or pre-market gap percentage, and then you're able to sort by ascending order or sort by descending order, and it'll give you a bunch of stocks that have overnight changes in price, whether it's a gap up or a gap down. Now, in terms of what I personally do every single day, I do most of my scanning on my actual Thinkorswim platform just because it makes it easier for me. So whenever you're on your watch list on Thinkorswim, if you right click this thing right here, go to customize, you could actually look for percent change or percent change since or percent in the money, or this wouldn't make sense, but percent change. I like to use mark percent change. I found that to be super useful, but you can kind of experiment. Sometimes I use other ones, but this is what I would do. You can kind of go to this column and type in percent change, and it'll give you a bunch of different options. And this is exactly how I scan for gaps every single morning. It's usually a combination between Thinkorswim and using percent change or mark percent change. And then I also use Market Chameleon in case I like missed out on some gaps, or maybe my scanner on Thinkorswim didn't include some. That's exactly what I do. Step number 2, now that you have your gap list, you have that list of stocks that are either gapping up or gapping down. Now it's time to assess the quality of every single gap and pick the specific stocks that you want to focus on for the stock market open and throughout the trading day, because you may have 20, 30, 40 stocks on your gap list, sometimes less, sometimes more. It really depends on the time of year. For example, during earnings season, when companies are reporting quarterly earnings, they usually report either in the pre-market or in the post-market. So we have tons of gaps during earnings season, and that's why earnings season tends to be a really busy time of year. And you don't want to overwhelm yourself looking at like 20 different gaps. You want to pick, the specific gaps that you want to focus on for the market open. And there are specific criteria and qualities that separate high quality gaps from low quality gaps. And I'm about to teach you how to do that. But first, you need to check the price in which the stock is gapping to. So for this, depending on what brokerage you use or what scanner you use or what platform you use, it's going to tell you where it's gapping to. Like, what's the pre-market price of that stock? And that's what you're going to look at. And from there, you're going to go to the daily time frame on whatever platform you are using, and you're going to look on the charts, where is the stock gapping to? So for example, on Apple, we closed on Friday at like $200. If Apple opens at 190 versus let's say 173, that is a massive difference, and that could have massive implications on the quality of the gap. So it's important to identify the location in which the stock is gapping to, because it could have a dramatic impact on the quality of the gap. So it's very important that in the pre-market, you're looking at the daily chart, you're looking at the pre-market price, and you're checking where the stock is gapping to. Now it's time to learn about how to assess the quality of every single gap that you look at, so you could pick which stocks you want to focus on for when the stock market opens and throughout the trading day. And this is by far the most important component of your gap scan and your pre-market analysis. You need to identify the high quality gaps versus the low quality gaps. And this is really what's going to differentiate you from all of the other gap traders out there. This skill set is beyond important when it comes to pre-market scanning and then even intraday scanning as well. So let's keep it simple, right? So even if you're a beginner trader, you're going to be able to understand everything that I'm about to talk about. We are looking for gaps that, number one, are clearing directly above a resistance area if it is a gap up. Remember, I like to trade 90% of the time in the direction of the gap. So if it's gapping up, my bias is to go long during the intraday timeframes. For that case, we want it to be gapping above a resistance area. We don't want it to be gapping into resistance. We want it to be clearing and gapping above that resistance. And I'm going to break down exactly what that means in just a second. I just want to kind of go over all of the points real quick, and then we're going to go into the specifics. And the opposite applies if it's a short. If it's gapping down, my bias is to go short. I want it to be gapping below support. All right. I want it to be clearing a key support area. So that's the first thing we're looking for. Number two, we look for gaps that are either ending a long-term or short-term trend, or that are surprising buyers or sellers, or shocking buyers or sellers, or even trapping buyers or sellers. And this is so powerful. I'm going to show you how this works. These are the most powerful gaps that you could possibly find. Gaps that end trends and that shock buyers or sellers. We also like gaps that trigger high time frame setups off the daily time frame or off the weekly time frame. And we also like gaps that have room to move. So let's say we're clearing a major resistance area. We want to make sure the stock has room to actually move up before it hits the next resistance area. So these are all the points we're going to look for. And now let's get into the details. So off the bat, let's start off with support and resistance requirements. So let's break this down. We have a very established downtrend, and then we begin consolidating at the lows, and we close right here the previous day. The next morning, we gap down, and notice how we are gapping down beneath this consolidation. We're gapping beneath this area of support, and that's exactly what you're looking for. You don't want it to gap into the consolidation. You want it to gap underneath support, underneath the consolidation. So it's actually clearing every single low, right? You want it to be opening below every single low right here. And that would effectively mean it's gapping below support. Same thing applies if it's above resistance. Established uptrend, and then we begin to consolidate at the highs. We close here the previous day, and the next morning we gap up. Notice how we're not gapping into the highs. We're gapping over the highs. We are clearing these highs, right? So we're gapping above that resistance area, and that's exactly what you want to look for. Now, another really key point is that notice how I said directly above resistance. I didn't say a massive amount above resistance. I said directly above, right? So we don't want massive gaps above resistance or below support. A lot of people think that the bigger the gap, the better the gap, and that's not necessarily true, right? So let's say instead of us opening here, we opened all the way down here, way below support. We don't want that, right? We want it to be gapping directly below support, not like crazy far away from support. Does that make sense? Next, instead of it opening directly above resistance like it is here, imagine it opened all the way up here, which, you know, has a massive distance between yesterday's closing price. It's way above this resistance area. We don't want that. We oftentimes actually call these mega gaps when the gap is so big that it almost loses its power. It loses its effect because it's just completely gapping off of the charts. And a lot of the investors, right, like imagine you were in it short right here and all of a sudden the gap's all the way up here, right? You might like panic sell, but you might also just be like, okay, well, I'm just going to wait until it comes in. I'm already down so much money. I'm just going to wait until it comes back down. So we want it to be directly above resistance, directly below support, not like a massive amount away from support or resistance, right? And that's really demonstrated here as well, right? So we don't want it to be gapping into support. We want it under support. So this is an example of it gapping into support or gapping into resistance. We don't want it to be opening into the previous low or into the previous high. We want it to be clearing the previous low or clearing the previous high. Does that make sense? All right, now let's go ahead and move on. We also look for gaps that end trends because they could be unbelievably powerful because they ultimately trap and shock the buyers or sellers. So here's a really good example of that where you have a really established downtrend, right? You close right here the previous day, and then all of a sudden the next morning you open right here, right? Like think about how shocking that could be. Let's say you're in it short either from here or from here or from here. You know, you're going to sleep at night feeling good, your position is up, it's looking lower, everything's great, making money, and all of a sudden the next morning it gaps all the way up to basically right here where it essentially just ends the downtrend. Like think about how you might feel waking up to your position now down hundreds and hundreds of dollars or thousands of dollars or hundreds of thousands of dollars. Think about if you're an institution who went short right here, for example, and all of a sudden the stock is opening up here, right? That's going to put pressure on you and everyone who went short to ultimately cover their position. And when they cover their position, position, they're buying their shares back. That's what gives prices the momentum to move higher, right? Or a gap that ends in uptrend, right? Let's say you went long right here and the price closed here the previous day. You're feeling good, you're making money, and all of a sudden it opens down here. Next morning, prices are down here. Aren't you going to panic? You're gonna be like, oh my God, I'm down, I'm losing a lot of money, and let's say it begins to drop. Let's say it starts to drop a little bit. And then you're like, oh my God, it opened, my position is more and more in the red, I'm losing more and more money, right? That's going to put more and more pressure on you to just cut your losses and sell. And that's what gives prices the momentum to continue lower. And this is why gaps that end trends or that shock buyers or sellers are powerful, because it puts those buyers and sellers in a position that they don't want to be in. It puts them in a position where they have to cut their losses or otherwise they're going to lose way more money. Alrighty. And we also like to look for gaps that are below green bars if we're going short, right? Or above red bars if we're going long. So if it's opening below a green bar, it is trapping all of the buyers from the previous day. And if it's opening above a red bar, it's trapping all of the sellers from the previous day, right? So a gap below a green bar is powerful. A gap above a red bar is powerful. And I know we kind of just went over theory, but let's look at some real life examples here. So let's take the PLCE. This is a gap from a couple of weeks ago, where on the previous day, we closed right here. And then the next morning, we opened right here. So let's see if it fits the criteria, right? We want a gap that opens below support. This is a support area. This is a support area. Yep, we're opening below this support area. We're also essentially ending this uptrend, right? We have this kind of mini little trend here. We're ending that trend, and we're also gapping below all of these green bars. Like, think about it. Everyone who bought it this day or this day or this day, they're waking up to now prices moving against them. That's going to put pressure on them to cut their losses and sell. And that's exactly what happened. And we saw really nice follow through on this day. And we actually, dropped right into this prior support area. So this support area was kind of like target, right? We gapped right here. Next support area, we looked to the left. Next support area was target. And that's exactly where it dropped to. Really beautiful gap. And in fact, it continued lower. And this is the daily chart. So it continued lower the rest of the week. So you could see how powerful this could be even for like swing trading, right? Where you could find really powerful daily gaps that are ending trends, that are clearing support, that have room to fall. And you can even look for ways to swing trade it. Take a look at this gap right here. So we have this kind of like multi-week consolidation. We have a very clear support area right here. We gap directly below it. We gap directly below a green bar. And we also kind of have a setup on the chart. We're kind of consolidating here, consolidating. So we have a setup on the higher time frames. We have a breakdown, and we trigger that breakdown through a gap down. We open here, which, like I said, below support. And if you look to the left here, we do have kind of a bunch of resistance. We have this resistance area right here, and we also have this pivot right here. But this stock just didn't care. It had so much momentum to the downside. I don't know what the news was, but it had so much momentum. This was such a massive catalyst for the stock that it just ripped through all of that support. And it was just a picture perfect gap. And I remember I remember kind of writing this stock off in the pre-market because I didn't think it was liquid enough to trade. And then funny enough, it was, and it just produced such a massive move. All right. Now let's look at the NASDAQ. Let's look at the Qs real quick. And there was just an unbelievably powerful gap on it right when the tariffs really came out, where we topped here. We moved down, then we kind of bounced around. And I think a lot of people were saying that we bottomed on the NASDAQ right here. This is the QQQ. This is the tracking ETF for the NASDAQ. A lot of people were telling me, I was reading on Twitter, a lot of people thought that we bottomed, and a lot of people were going aggressive with longs thinking that the market bottomed. We had 3 green bars in a row, and I think we ended up gapping down the next day from here to right here. And look at the effect that this had on the chart. And by the way, we're gapping below 3 green bars. And notice how it's a downtrend. Or we have a high, we have a low, we have a lower high, then we have a lower low and a lower high, and then we gap down right here, and it just shocked all of the buyers who bought it the previous day. And you could see that, I mean, look at the move that it triggered here. And we literally just basically capitulated right after that. Unbelievably powerful gap, right? It trapped all of the buyers who bought it the last 3 days on this gap, and then it just completely tanked. Beautiful. And you could even say that this was kind of a higher time frame setup, that this was like a sell setup. This was a retracement into the declining 20 MA. on the daily time frame, going over what those setups are and how to apply them with this gap strategy. However, I highly recommend watching my free 10+ hour trading course. It is genuinely better than most paid courses on the internet, and you can combine everything that you learn in my free course with a lot of my YouTube videos to really build the foundation for your trading. So I highly recommend going to my free course and learning about the sell setup that I just talked about, or the buy setup that I am about to talk about, and of course the breakout, the breakdown, the 1 2 3, and all of the other setups that I trade. So let's take a look at this APLD. We bottomed here. We went on a nice little uptrend. We have a rising 20 period moving average below price. We have a high here, and then we begin to pull back, and we have 3 red bars in a row. And then the next day, I believe we opened somewhere right here. So we opened above those red bars. We have an established uptrend. We also opened above this resistance area. And I saw this in the morning, and this is actually a setup that I called in my mentorship community as well. And you could just see the move that it produced. I mean, take a look at this. Look at this move. And this was that day, but you could see even the next few days. I mean, this thing just mooned like crazy, but look at this gap, right? This gap right here. And that gap was the catalyst for this massive move to the upside. We cleared over this resistance area. We gapped above 3 red bars, and we also triggered a higher time frame setup. We had a very clear buy setup on the daily time frame. We have established uptrend, rising 20 MA, pull back into the rising 20 MA. We have an entry bar, and we trigger that buy setup through this gap, right? Where we gap up, we trigger the buy setup, and boom, we just go off on a rocket ship. And there was even a daily 1 2 3 here as well, where we had an igniting bar, we had a resting bar, entry over that resting bar, stop loss below, and it continued higher. So like I said, watch the free course, because like the 1 2 3, the buy setup, it's important to know that for this video. All right, but I am going to go over briefly what that is in a second, and I am also going to show you how to trade these gaps on the intraday time frames. Let's look at Coinbase. This is another just beautiful gap, very similar to the APLD. We bottomed here, we moved up. 20 MA is now under price. Prices are respecting it, and we kind of had a little bit of a breakout here, and we triggered that breakout by gapping right here. We're gapping above this resistance, we're gapping above this resistance, we're gapping above the 200 period moving average. We're opening right here. You look to the left, we have plenty of room to the next resistance area, which is really like right here. So we have plenty of room to move higher. And let's take a look at the move that it produced. And Coinbase was just brilliant that day. I mean, such a nice gap, right? Above the 200, above all of this resistance. Beautiful setup on the charts, right? We have kind of a move up, basically a breakout. We have a breakout right here, and that breakout was triggered by this daily gap. All right, let's move on. Let's look at the UNH. And this was the company that there was a lot of news on it. A lot of people were talking about it on Twitter, and a lot of people were discussing how United Health, this was like, I think it was like $600, and you'll see where it ended up gapping to. But I think we opened right here, somewhere around there, right? So this thing, very solid uptrend. This thing looked like it was going to make new all-time highs, and all of a sudden it ends this uptrend completely. I mean, this is an extremely established trend to the upside. It looks higher. If anyone, any professional or retail trader looks at this chart, they're like, yep, that looks higher. This is an established trend. And we open right here below this pivot, right? We are kind of into a little bit of an area of support, but it just didn't matter at all, because you could see what happened directly after. On that day, we just had such nice follow through to the downside. And this is what happened afterwards, right? So this was that day, and you could see where the stock ended up falling to. This gap essentially ignited a brand new trend, because it shocked all of the buyers who were in it long, basically this entire trend higher, right? It shocked everyone. It trapped all of these buyers, all of the long-term investors, all of the traders. And you have to understand, when you have a really powerful gap like this that ends a trend or gaps below a lot of green bars, it's almost like a snowball effect of selling. Because think about it, right? It opens here, it starts to drop. Maybe there are some traders or investors that are like, hey, this is a good company. I'm just going to wait until this moves back up, right? So it drops. then it drops again, then it continues to drop, and all of a sudden their position is becoming more and more red, and it becomes a snowball effect of selling. And that's why these gaps are just have such a strong catalyst, and that's why they move with so much momentum. And we as professionals could take advantage of that snowball effect. We could take advantage knowing that those investors and traders are trapped and they're likely probably going to sell. So this is a really good example of a gap that's ending a trend. Let's look at Chegg. This was, oh my God, picture perfect. So we have a really established downtrend. I mean, look at the 20 MA. Look at how well prices are respecting the 20 MA. I actually have a video on my YouTube channel that teaches how to use the 20 period moving average. I also teach it in my free course. But so we move down and we have basically, a little base breakdown. We have a little bit of a consolidation here at the lows. And maybe there were some investors that thought that, hey, this thing double bottomed. I'm going to start buying here. And it started to move up. People thought that, hey, maybe Chegg bottom, maybe Chegg is about to move higher. They started to go long, and all of a sudden we opened like right here, directly below this support. We trapped the buyers who bought it the last 3 days, and we're continuing also the long-term trend. And it was just beautiful. And I remember trading in this day. I mean, it made me a bag. I don't remember, this was weeks ago. I don't remember exactly how much it made, but it was such a nice trade. And look at this. I mean, picture perfect. It closed at the lows. It closed literally at the lows of the day because it was such a powerful gap. It was continuing this long-term trend to the downside. It shocked the buyers who bought it the last 3 days. And also it triggered basically a sell setup break daily time frame. We have a sell setup consolidation at the lows. We triggered that setup by a gap down. Beautiful. And notice how we didn't gap down here and dropped. We gapped directly below support. Beautiful. Trapping all the buyers. Just picture perfect, honestly. All right, let's continue onward. We have the Yext. So this was essentially just a base breakout on the daily time frame. I think we opened right here or so. So we were clearing essentially this entire area of resistance. And the next resistance was basically all the way up here, right? And it didn't really shock any buyers or sellers, right? Because you look at the previous day, it was actually coming off a green bar. So it was already getting bought. It just essentially continued that momentum the next day. And let's look at what the gap ended up doing. And boom, I mean, insane green bar. Notice this is literally the biggest green bar on the chart. Look at all of the candlesticks. The biggest green bar was ignited from a gap where it essentially triggered a base breakout above resistance, and it actually cleared the previous resistance as well. It literally cleared it. It was such a powerful gap. Beautiful, beautiful. All right. And by the way, all of these charts, this is not me cherry picking. I do this pre-market scan every single day, not only for myself, but for every single one of my mentorship students that trade live with me every single day. We do this analysis every morning at 9 a.m. All right. So all of these stocks are stocks that were just on my personal scanner that we either traded that day and made money off of, or it was like on our radar and maybe we didn't catch that specific trade, but it was on our watch list. Let's look at the Chegg, another great example here. Right here, we have a red bar. We closed right here, then we opened right here. Now, this wasn't that great of a gap, and I'll tell you why. We do have an established uptrend, right? Respecting the 20 MA, respecting the 20 MA. This was a really nice buy setup, by the way. Moved up, retraced, really nice buy setup. We had a nice red bar the previous day, so it started to get sold. I'm assuming the people who bought it started to take profits, and then all of a sudden it was gapping from here to right here. But it was gapping right into this area of resistance, and it was also gapping into the 200 period moving average. Now, it didn't care. It still went higher, but the point that I'm trying to make is not every gap is going to be a picture perfect gap. They're not always going to be perfect, right? Like A+. I don't want to say they're rare, but you're not going to get them every single day. You're not going to get 5 a day. Sometimes you could still make money off of like B gaps or even C+ gaps, right? And we do that, all right? But generally speaking, you do want to trade the highest quality of gaps. Okay, so I just gave you a ton of different information to understand for how to assess the quality of a gap and what we specifically look for. But you probably are a little bit still confused on how to actually trade these gaps. Like, where do we enter? What do we actually do when we see a high quality gap on the daily time frame? And you need to understand that the gap sets the bias. And from there, once we know what the bias is, once we know what specific stocks we want to focus on, the ones that have the highest quality gap, once we know the direction, right, we go to the intraday time time frames to trade that bias. We don't just buy a gap up, right? Let's say you have a really interesting gap up. It's clearing over resistance. It's trapping sellers. It's ending a downtrend. It's looking really good on the daily time frame. We don't just buy it. No, you need an intraday setup. So the gap sets the bias, it sets the direction in which we want to trade in, and from there we combine that with the intraday predefined simple setup, and we're about to talk about that. But I know people are going to ask me about time frames. So in the pre-market, I'm scanning for gaps, I'm picking which stocks I want to focus on for the market open, and then when the market does open, as I'm looking at the daily chart and where the stock is opening, I'm looking at the 1 and the 2 minute charts from like 9:30 to 10 a.m. And I'm also looking at the 5 minute as well, closer to 10 a.m. Then from 10 a.m. to 12 p.m., and this is Eastern time, by the way, I'm looking at like the 2 minute chart and the 5 minute charts. And I'm also starting to look at the 15 minute chart as well. And then from 12 to the end of the day, I'm primarily looking at the 5 and the 15 minute time frames. Now, even when I'm scanning for new stocks to trade that day, I'm always looking at the daily chart first. I'm always assessing what is the gap, or is there a gap in the first place? And a lot of times, if there's no gap, I don't even look at the intraday time frames. If the daily chart isn't interesting, there's no quality gap, there's no momentum, the daily doesn't really have anything to be interested in, I don't even go to the lower time frames. I look at the daily chart, I assess, is there a gap? Yes, great. Is there a high quality gap? Yes, great. That's when I go to the intraday timeframes to look for a setup. Now, what setups do we trade? And it's really simple, guys. Like I said, just watch the free course. It'll teach you all of this. But we look for either a retracement setup or a consolidation. So this is essentially a buy setup or a breakout. That is exactly what I trade. All right. We keep it really, really simple, right? I don't like to overcomplicate my strategies. I don't like to use crazy indicators. I keep my trading as simple as possible. I think the simplest things in life are oftentimes the most brilliant. I keep it simple. So once I have the bias, to trade that bias, I either trade a retracement pattern, which is a buy setup, or I trade a breakout, which essentially is like a consolidation pattern. Now, I also want to show you a strategy that you can implement literally in the first few minutes of the day, because there are times where I will hop into a trade that has a really high quality gap right off the open, like the first 5 minutes of the day. Because sometimes these gaps, let's say you have a really nice gap down, it won't set up, it'll just go. And sometimes you kind of have to just jump into it to capitalize on the trade. However, we don't want to just randomly jump in. We still want structure for our trades, even if they're right at the open. But, you know, at the open, there hasn't been enough time to pass, right? If we're 2 minutes into the day, there's only 2 1-minute candlesticks. You can't really read a setup from that. You can't read a breakdown or a sell setup or anything. So what you can do is use the high-low pattern. And I think a lot of people call this the orb strategy, like the opening range breakout. Listen, I really don't care what you call it. I don't study the orb. Like, I saw that on TikTok and it was kind of similar to what I know as the high-low strategy, but doesn't matter. This is the strat. So what you're going to do is you wait for either the first 1 minute, 2 minute, 5 minute, or 15 minute candle to form. So the first one forms either 1 minute into the day, 2 minutes into the day, 5 minutes into the day, or 15 minutes into the day, depending on the time frame you're looking at. Now, if you're going long, right, let's say it's a bullish gap up and you want to go long, what you can do is you place your entry above the first candlestick, stop loss below. So you could put your entry above the first candlestick right here. Okay. And you put your stop loss below that first candlestick. And this provides structure. So you have a really nice gap up. You're noticing that it looks like it's about to pop. It looks like it wants to really get going and move to the upside right off the bat in the morning, instead of just hopping in randomly with no risk management, no stop loss, no predefined entry. You now have structure for the trade. You put your entry below the highs of the first candlestick. You put your stop loss below the lows of the first candlestick. Now, the same thing applies when going short. It's just the opposite. You would place your entry below the lows. You place your stop loss below the highs. And right off the bat, I already know what you're thinking. You're like, okay, this is easy. Just wait for the first candlestick to form. And then if you're long, entry above, stop loss below. Going short, entry below, stop loss above. Makes sense. But which time frame do we use? Which time frame do we look at? Do we look at the 1 minute or the 2 minute or the 5 minute or the 15 minute? And ultimately, that is up to you. It really depends, right? So my suggestion is if you do it off the 1 minute or the 2 minute, especially right off the market open, that stock could be so volatile that it's going to quickly stop you out. My recommendation is to wait for either the 5 or the 15 to form. Maybe if you want to be super aggressive, you could do it off the 2 minute, where the first 2 minutes pass by, you have a 2 minute bar, and that's what you do the high-low strategy off of. My recommendation, I think a really good sweet spot is doing it off the 5 minute. And the issue with doing it off the 15, right, is you might end up having a massive 15-minute candlestick, right? And then all of a sudden you put your entry above, stop loss below, you have a really big stop. So now you have limited reward to risk. And then the upside of doing it off the 1 minute time frame is you might have a super small bar, right? So you have really, entry here, stop loss here, you have a really small bar, you have a really tight stop, you have a high reward to risk, but this thing might end up triggering, right? And then immediately stopping out. And then you end up losing a full R 1 or 2 minutes into the day because the stock is so volatile because it's right at the open. Does that make sense? So you need to find a sweet spot. My recommendation is just to do it off the 5 minute personally. But if you see a 2 minute high low where the first 2 minute bar is formed, it looks good, the stock is readable, it's not too volatile, it's an amazing gap, you feel like it's about to move, you can do it off the 2 minute and use the high-low strategy off the 2. Entry above, stop loss below if you're going long, or entry below, stop loss above if you're going short. So now we understand that the gap sets the bias. It gives us the direction in which we want to trade in when the market opens, but we don't just randomly buy or randomly short on a gap up or on a gap down. No, we need a predefined intraday setup, and that's exactly why we go to the smaller time frames to find that setup, whether that is a retracement or a buy setup or a consolidation or breakout, or whether that's a high-low strategy. If it's in the first few minutes of the day, we never enter randomly. We need to have structure in our trading. That's why we trade predefined, simple setups that are not complicated, they're easy to understand, and they're easy to know where our entry is and where our stop loss is, which allows us to easily manage our risk. Now, let's go back to the previous setups and gaps that we were looking at, and let's look at the intraday setups on those. So we have the APLD, right? So this stock gapped up above 3 red bars over resistance. We already went through it. And let's look at the intraday setup that occurred on this day. And I actually distinctly remember this day because we traded this intraday setup. I called this in my mentorship group and we traded and capitalized on it. Now, let's take a look at it. So we have a very, very clean 5-minute buy setup, right? So what is a buy setup? That is a retracement pattern, where we have a move up, 3 red bars in a row, great. Now we have a bottoming tail, entry bar, perfect. Entry would go above that bar, stop loss below, target is the previous high, and we actually surpassed that previous high. And if you look even later into the day, we kind of had another little buy setup right here, right? Where we moved up, retraced, moved higher. This one wasn't as high quality, but I definitely like this one where we kind of moved higher, 3 red bars in a row, entry above, stop loss below, and we made a new high. But the best one was really this one. It was just such a clean buy setup. And you might be thinking, hold up, for a buy setup, especially if you've gone through my free course, you're definitely thinking if it's a buy setup, then it needs to be close to or near the 20 period moving average, which is this line right here. I understand that there is some distance between price and the 20 MA. However, you need to understand that on a big gap, on a sharp gap up, it's going to take time for the 20 period moving average to catch up to price, right? Because it randomly just popped right overnight. And you could see why, the 20 MA really has such a sharp slope because it's trying to catch up to prices. So in the first 30 minutes of the day, even first hour to hour and a half of the day, you could use the 9 MA in conjunction, or the 10 MA in conjunction with the 20 MA, right? These can serve as your 20 MA in the first hour of the day, especially if it's a big gap either up to the upside or to the downside. But you could see we had a beautiful gap down or gap up that was bullish, triggering a buy setup on the daily here, above 3 red bars, above resistance, and we traded that bias through a 5-minute buy setup. Now let's look at the Coinbase. We already went over this gap, above resistance, above the 200, above a couple of red bars, triggering a breakout, has plenty of room until the next resistance area. Lovely. Now let's look at the intraday time frame, and we see that, what do we see? And I want you guys to kind of answer that. I want you to pause the video and really think about it. But I'll tell you the answer. we just have an amazing uptrend where prices just are respecting the 20 MA. And right off the bat, we have a nice breakout right here over the highs, stop loss under the lows. That kind of chopped around for a while until the 20 MA caught up. And then as soon as the 20 MA caught up right here, that's when it decided to really run. So you could have even traded it as a breakout here. With your entry above the base, stop loss below this tail. You could have even put your stop loss below this base if you wanted a tighter stop. And in theory, if you want to be super aggressive, we have somewhat of a 5-minute 1, 2, 3 here, where we had a igniting bar, doji bar. You could have even put your entry above that doji bar, stop loss below if you really wanted a tight stop, but that's super, super aggressive. And then even here, we got a buy setup and buy setup again. And you can see how well it's respecting the 20 MA. Just beautiful, beautiful gap and beautiful uptrend on the intraday time frame where you could have traded either a breakout here and then you saw it chop around for a bit, or you could even enter the breakout here, or you could have traded as a buy setup here. Just a bunch of different setups that you could have traded on this stock, right? But that's the idea. Gap, then you go to the intraday time frames and you find a setup. Let's look at this. Same exact thing on the UNH. And this is actually a great example. We already talked about the UNH. This is a great example of a high-low where you could have, right, you have this first 5-minute candle that formed. You could have put your entry below that first 5-minute candle, stop loss above the first 5-minute candle, and you would have capitalized on this move lower. Now, it would have been a really big stop. That's the only issue. So what I would have personally done is I would have traded this as a 5-minute 1, 2, 3. Igniting red bar to the downside. We have a resting doji bar, entry below that 1, 2, 3, stop loss above. And like I said, watch the free course. I keep saying it, but all these setups, it's important to understand it. I teach the 1, 2, 3 in that free education, so watch it. But this could be a nice 1, 2, 3, and it continued lower. Just amazing trade, honestly. So you could have done it as a high low or as a 5-minute 1, 2, 3. All right. So bearish gap down, and we traded that bias through those setups that I just mentioned. Let's move on. Chegg. Let's look at the Chegg. We already talked about it. Beautiful gap down below these 3 green bars, continuing this long-term trend below support. And let's look at the intraday setup. And we have just a really clean breakdown. We move lower, we consolidated. Check this out. You know what this is right here? This is what's called a shakeout bar. This is called a breakout failure, where notice what happened. We dropped, we began to consolidate. From there, we attempted to move higher and failed. And then we got the move lower. Just beautiful, right? You could see that topping tail. The buyer stepped in, tried to bring prices higher, and then the sellers were like, nope, this is bearish. There's a bearish gap. You're not bringing it higher. And they brought prices right back down. So it was like a failed breakout. Either put your entry here, stop loss above, right? So entry below the base, stop loss above. Or you could have, even if you want to be aggressive, like I remember trading this, I entered below this doji, stop loss above, which obviously isn't textbook, right? For a breakdown, we want it to trigger underneath the base. As soon as I saw a breakout failure on a really bearish gap with a really bearish base breakdown on the 15-minute time frame, I was just like, yep, I'm hopping in. And I think I went to either the 5-minute chart or the 2-minute chart for a much tighter stop and a much tighter entry. Let's move on to the Yext. We already talked about the gap above resistance, triggering this base breakout. And let's look at the intraday setup. And we have just such a clean, this is the 5-minute time frame, such a clean high-low. Entry above, stop loss below, and look at that move. Wow, just insane. And then it consolidated. Literally, it consolidated for a while right here. And you could have traded this as a breakout. Entry above the base, stop loss below, and capitalized off this move, right? And then this would have been the target, which basically that's where it got to. All right. Do we have any more? Yes, we do. Let's look at the Chegg. This is actually a pretty recent trade. This is the one that I said it wasn't that good because it was into resistance. But let's look at the intraday setup here. And we kind of have like a 1, 2, 3 / breakout. So I remember I called this over this candle, stop loss below. And we caught this move, but then there was also a really nice 5-minute buy setup. So a lot of my students and I, we caught this move off this breakout, but then you could have even traded this. 3-bar pullback, nice entry bar as a 5-minute buy setup, really close to the 20-period moving average. Entry above, stop loss below, and you would have literally just caught, number one, this move, then it pulled back, one more buy setup. And then funny enough, it had a base breakout. So entry above, stop loss below. So you're seeing this like on literally just a Chegg on this uptrend. How many opportunities did you have to enter it? You had this initial opportunity, number one, 5-minute buy setup, number two, another 5-minute buy setup, number three, and a 5-minute breakout. 4 potential setups. You can even say 5. You could say this was a buy setup as well. That's 6. right? And by the way, this was like a low quality gap. This was like maybe a B minus C plus gap. But even on a B minus C plus gap, you see so many potentially, interesting opportunities on the intraday to trade that bias. Before I do a summary of the entire video, this chart essentially explains why we focus on gaps. I want you to identify the two biggest candles on this chart. Literally pause the video and find the two biggest candles. And if you did that, you would see that it's this one and this one. And both of those candles were ignited by a gap where we have a really nice uptrend right here, respecting the 20 MA. We move up, we consolidate into the rising 20 period moving average. We have a really nice daily breakout. That breakout was triggered by a gap and boom, it just mooned from there, right? And we did have resistance to the left. It didn't care. It just ripped right through it. Looking at this one, another really nice established uptrend, higher highs, higher lows. We moved up, had a nice buy setup into the rising 20 period moving average. We triggered that buy setup through a gap up and boom. And by the way, we had resistance as well to the left here. Did not care and it just ripped right through that resistance, right? And by the way, I always like to look to the left to find the next resistance area. So in this case, the first resistance was right here, which it cleared that. And the second resistance was right here, which it literally it cleared that as well. But usually I like to use resistance areas and support areas as my target for trading gaps and trading the intraday setup on the gap. Now, quick little summary, guys. We learned exactly why we trade gaps. They have way more momentum. They have a catalyst behind its movement, and they just move way more than non-gapping stocks. 90% of the time, I am trading in the direction of the gap, right? There are exceptions to this. There are times where I'm going against the gap, but I'm not going to talk about it in this video. We already talked about a ton of different stuff. One more thing I should note is that if you have a gap up, right, we are looking to go long, but let's say we have a gap up and it starts to sell off and it starts to drop. I just don't focus on it anymore. I don't trade it short. I just don't focus on it. So I don't like to trade the gap fill. I trade in the direction of the gap. And if it starts to fill the gap, I just ignore it. Same thing if it's a gap down, I'm looking to go short. That's my bias. But if it starts to move up, most of the time I don't focus on it anymore, right? We learned about how to find gaps in the pre-market, all the different websites. I like to use Thinkorswim and I do use Market Chameleon at times. We check the price and from there we check, is it clearing above resistance? Or is it clearing below support? Is it shocking any buyers or sellers? Is it triggering a breakout or a buy setup on the daily time frame? Does it have room to the next resistance area, right? We talked about what we look for when it comes to support and resistance requirements. And then from there, we talked about just a bunch of gaps and what we specifically look for in gaps. And remember, we want gaps that are powerful, that are shocking buyers or sellers, that are making buyers and sellers uncomfortable to be in the positions that they're in. And that's where the biggest opportunities lie. It's very, very important. And the final note I would say is that always remember, we don't trade the gap. We need a setup. Right? We can't just enter randomly into a nice gap up. We need an intraday setup, whether that's a retracement or a consolidation or a high-low strategy. The next chapter covers a very important concept in trading, and it's called trade management. And I'm going to teach you exactly how to manage your positions when you're actually in the trade. I'm going to teach you when to trail your position. I'm going to teach you how to extract as much profit as possible from a winning trade and how to limit your losses on your losing trades. The first step when you're looking at a potential setup is to find your entry point. However, the second step is to manage the position to the best of your ability so you can make as much profit as possible while protecting your downside. And that's exactly what this chapter covers. So I'm going to be giving you a ton of different trade management strategies. So let's hop right into this chapter.
What is going on, guys? Hope you're having a great day. Today, we're going to be talking about managing your position, right? Trading management. And I got a cup of coffee with me, and we're going to be learning some amazing stuff. So let me get a quick sip before we actually begin. Okay. So I know a lot of people struggle with this topic where they enter into a trade and let's say they begin making money. Right? They're profiting and they don't know exactly what to do, right? They don't know whether to just take profits or, they don't know how to exactly manage that position. And you guys have to understand that managing your position is an art. It's not a science, okay? There isn't one way to do it. In fact, every trader is going to have sort of a different trading management system, right? Something that suits, himself, and you kind of find that out over time. Through experience, you're going to learn what suits your personality and what sort of trading management works for your type of positions. But let's just get right into the presentation here, okay? We got how to manage your trades. Let's go. So let us consider two different possibilities here. We have outcome number one. So let's assume you just opened a new position. You have already identified your entry, your stop loss, and targets for the position, right? So if it's a buy setup, if it's a breakout, if it's a breakdown, maybe it's a 1, 2, 3, whatever it is, you should already know exactly what your entry price is, stop loss price, and what your target price is, or approximate target price. Now, let's say the trade doesn't work out in your favor, and the trade actually hits your stop loss. You're going to exit the position and take the loss. There's really no confusion here. If it hits your stop loss, you exit the position, okay? There's only really one outcome. If the trade doesn't work in your favor and it hits your stop loss, there's really no management necessary. You've already identified your stop loss prior to you even taking the trade. So if it hits your stop loss, you're out of the position, no questions asked, no confusion, okay? Now let us consider another outcome. Let's say the trade that you took is a winner, right? You get into the trade and it starts going in your favor and it's a winner. The trade, which it doesn't matter what security it is, whether it's stocks, crypto, forex, whatever. Let's say it's approaching target, right? And this is assuming you chose a target prior to the trade. There's going to be certain situations where, before you enter a trade, you're not going to be able to identify a target, right? And I don't really want to get into that too heavy. We're going to be talking about that during the, picking targets class. But let's say, the security is approaching target, or it's approaching the point where you want to start taking profits. What do? Are you just going to exit the position once it hits target completely? What if the position continues more in your favor and you actually miss out on some profits, right? Like, let's say it hits your target, you completely exit the position, but then the stock or crypto and your trade, it continues going in your favor. And then you end up missing out on all those additional profits. You really don't want that to happen to you. You don't want to miss out on more potential profits by exiting the trade too early, okay? And that's where trading management comes in. That's when, your distinct management system will come into play and you'll know exactly what to do once your position actually hits target, all right? So before we go into it, I just want to clarify a specific topic because I use this phrase a lot and I think you guys should know what it means. So I usually call it just getting shaken out of a position. So if I ever say getting shaken out of a position, this is what it means. So let's say you enter a position and you set your stop loss. Before the stock or crypto in your trade goes in your favor, and it eventually hits target, let's say it hits your stop loss first, forcing you out of the position and therefore missing the move, right? So let's say you get into a trade, right? The trade hits your stop loss. And right after it hits your stop loss, it immediately starts going in your favor, and and you would have made money on the trade for the fact if it didn't hit your stop loss, right? So that's what's getting shaken out. That's what that means, okay? Where it hits your stop loss and then it ends up continuing in your favor anyway. So how do you eliminate getting shaken out of a position? Well, number one, it's don't set too tight of stop losses. And I know that's kind of contradictory, right? We talked about in the risk management videos that you want to look for tight stop losses, right? And now all of a sudden I'm saying, oh, you can't have too tight of stop losses because you might get shaken out of the position, right? And it's kind of like a conflict. You kind of have to pick the perfect stop loss, right? And my recommendation is just pick the correct stop loss for that setup, right? If it's a base breakout, we know that we always place the stop loss under the base, right? If it's a buy setup, you know we always place the stop loss under our entry bar, right? So I would say just stick to the basics, like stick to what I've taught you guys. But this is kind of an issue. It's kind of they're kind of like butting heads where you don't want to get shaken out of the position, but you also don't want to have too large of a stop loss because then you're not going to really have all that much reward to risk. Okay, hopefully that makes sense. And so how to eliminate it? Yeah, don't set too tight of stop losses. Give the stock or crypto some room to fluctuate. Okay. Worst case, if you'll set a larger stop loss, it may mean less reward to risk, but at least you're not going to get stopped out and be forced to enter again or miss the opportunity altogether, right? So you might have to set a little bit larger of a stop loss, therefore making your stop larger, right? Therefore, you're going to have a worse reward to risk because you're not going to be able to buy or short as many shares, right? But that sucks or whatever, but at least you're not going to get shaken out and see that trade end up going in your favor anyway. So keep this concept in mind that you never want to get shaken out of a trade. You never want it to hit your stop loss and then have it go in your favor anyway. So let's take a look at this example here. It kind of looks a little confusing, but I'm going to walk you guys through it. We have a rally and we start to get a base, right? And we know what setup this is. This is a base breakout, right? And let's say your entry is right here, right? Your entry is over the base, right? So you're going to get triggered into the position right here with this green bar. So it hits your entry and now you're in the position, right? And let's say for this position, you end up placing your stop loss right here, right? Under these candlesticks. And remember, according to, the textbook theoretical version that I taught you guys, you should always be placing your stop loss under the lows of the base, right? So the correct way to place your stop loss would be under the lows of the base, which is this bar. So this right here is the correct stop loss. But let's say you wanted to have a higher reward to risk, so you ended up putting your stop loss up here instead of here, right? So you place your stop loss here instead of under the absolute lows of the base because you wanted to improve your reward to risk. Now let's say you get triggered into the position and all of a sudden the next bar is a red bar and we get a drop and it actually hits your stop loss that you placed here, right? It hits your stop loss here. It liquidates you out of the position before, on the next bar completely explodes and it goes right back up and makes new highs, right? But unfortunately, you're not in this play anymore because it hit your stop loss here, right? How to avoid this? Well, you should have placed your stop loss correctly in the beginning and put it underneath the absolute lows of the base. So as a result of you having your stop loss here, you got shaken out of the position before the trade actually went into your favor and would have produced very nice profits. So what's the conclusion here? Because you decided to use a tighter stop loss, right? Use this stop loss instead of this one. You got liquidated and you missed this move higher. Okay, so the theme here, guys, is place correct stop losses. Don't try to place too tight of stop losses. Otherwise, you'll have the risk of getting shaken out of the position before it ends up continuing in your favor anyway. Hopefully this makes sense, guys. I know I kind of repeated myself a bunch of times, but it's important that you guys understand this. And hopefully this all makes sense. If it doesn't, either go ahead and ask me in the server or just rewatch this video. Okay, so how do you manage positions that reach target, right? So let's say your trade has reached your target price, right? You were in it from down here and all of a sudden it hit your target price. What do you do from here? Well, you really have two options. Option number one, you take profits. You just exit the position as it hits target and you take your profits and it's a winning trade. Perfect. Or number two, you trail your position and you raise your stop. Okay? And we're going to talk about this in a second, but this for the second option, that's where the trading management comes in. So let's talk about option number one. Let's talk about the take profit option first. So take profit. You can either, number one, exit your entire position, right? Where you just liquidate your entire position, you're completely out of the trade. Or number two, you take some profit here and you leave the rest of the position open in case it continues higher in your favor, right? So by doing option number two here, you're securing profit, right? At that point, it's 100% a profitable trade. You're securing profits, and then you're allowing, that other half of your position or the other, however much you left in the position, you let that run and hopefully make you more profits. So that ends up, and by the way, you might be thinking, okay, but how much of the position should I take, right? Like if you want to take some profit, how much profit should I take? My recommendation is take at least 50% of your profits. If you made $200, secure at least 100, or even do 75% where you secure let's say like $150, right, out of 200, and you let the other $50 kind of run. In worst case, if you lose that $50, well, you secured 150 already. It's for sure a winning trade. But when we're talking about leaving the rest of the position open, right? We take some profits and we leave the rest of the position open. Well, that begs the question, how do we manage the rest of the shares that you left? How do you manage those shares that you left in the position? What do you do with them? When do you take profits for them, for those shares? Where do you place your stop loss for those shares? Okay, so let's get into it. I'm going to take a sip of my coffee real quick. So 1 second. Okay, perfect. So your first option in trailing your position, right? So the stock reached target. However, you still think this can continue higher, right? So let's say it hits your target. Let's say this is a buy setup, right? It pulled back. This is a buy setup. And the buy setup hits your target, right? But you think this still has potential to move higher. What do you do? So what you could do is wait for the pullback to complete, right? I'm talking about this pullback, and raise your stop to the new pivot low. And this doesn't only apply to a pullback. Let's say it ends up basing as well. You could also raise your stop loss to to right under the lows of the base. So like I said, you wait for the pullback to complete and you raise your stop to the new pivot low. So this is your original stop loss, right? We have a buy setup here and your stop loss is under this entry bar. What you could do as soon as it hits target, and let's say it pulls back or it bases, you raise your stop loss to that new pivot or the new lows of the base, okay? So by raising your stop loss, what you've done here is you have 100% secured profits. Because remember, your entry is right here, right? Your entry is right here. By raising your stop, you have secured profits, right? Because let's say you raise your stop here and let's say it attempts to go higher, but then it fails and then it hits your new stop. Well, if it hits your new stop, at the end of the day, you're still making money because, this stop is over your entry. So what are the pros of this? Well, number one, you give yourself the ability to aim for a larger target while securing profits with this new stop loss. What are the cons? Well, the cons is the pullback can continue and you can give back your profits. And it's talking about this pullback, right? Where let's say you hit target right here and you think this can continue higher and you're waiting for this pullback or you're waiting for that base so you could raise your stop loss. But instead, this pullback just continues dropping and dropping and dropping, and it ends up hitting your original stop. that might happen. And then you end up having a winning trade go negative and hit your original stop loss. You definitely don't really want that to happen either. So at the end of the day, guys, it's kind of up to you. You know what I mean? I'm kind of giving you guys the different strategies that exist, but it's up to you for what you actually want to do. But in general, guys, you always want to raise your stop loss. It's a very good way of securing profits while allowing the position to continue higher. So this is one way of doing it, where you're raising it to the new pivot low, or you're raising it to the new low of the base. Now let's talk about another way you can trail your position. So let's say the stock, right? This is a buy setup, right? We get a pullback. You have a buy setup. You enter here. Your stop loss is right here. Let's say the stock or crypto has reached your initial, it's reached your initial target, right? However, you still think this can continue higher. What do? What you can do is trail the position bar by bar. Okay, what does that mean? So as soon as the target is reached, you trail the position to the prior bar's low, right? So let's say you have, this is the bar that hits target, right? This is the bar that hits target. What you can do is raise your original stop to this bar's low, okay? You raise your original stop to this bar's low. So in that case, if it goes against you, well, it's going to hit your stop loss and you've secured profits, right? And once, let's say this bar has finished forming, then you're going to raise this stop to under this bar lows. And then as soon as this bar finishes forming, you raise it to that bar's lows. So as you can see, as each bar is moving higher and higher and higher, you're continuously raising your stop loss to each bar's low. And by doing that, you're giving the stock or crypto room to fluctuate, right? Like let's say that you raise your stop loss here and this bar is already forming. It gives this bar the opportunity to go up and down a little bit before it continues higher. Like remember, stocks and crypto, they don't just go infinitely up. Sometimes they go up, sometimes they go down. By continuously raising your stop, you're giving that stock or crypto room to fluctuate while also, having a tight enough stop loss where you're able to secure profits, okay? So what's the pros here? Well, you give the trade some room to continue higher while you're maximizing profits. However, a con of this is if you're thinking to yourself, okay, cool, I get the theory of this, right? I get the idea. When it hits target, you're raising your stop loss to the bar's low. But which time frames am I going to use? Which candlesticks am I going to use? That's where the difficulty comes in. It's kind of difficult to decide which time frame you're going to use. But guys, by either trailing your position this way or by trailing your position this way, what you're doing is you're allowing the trade to continue earning you more and more money, even though it already hit your target, right? So by doing this, you're giving yourself the opportunity to still have stop losses securing profit, but also giving the stock or crypto the opportunity to make really big gains, right? It gives you the opportunity to have huge winners, right? Because you're constantly raising your stop loss as the stock or crypto continues higher. Okay, hopefully that makes sense. So trailing bar by bar time frames. Let's talk about the different time frames you could use, right? So if you're swing trading, right? Remember swing trading, that's you're looking at the daily chart and the weekly charts, and then you're using the hourly charts for entries. If you're swing trading, you can trail your position bar by bar on either the hourly or daily time frame. Okay, hourly or daily time frame. So I can actually go ahead and show you guys an example of that. Let's see, I don't have my charts up actually, my TradingView charts up at the moment, but I can show you guys an example in a different class, showing you guys how to apply this. But right, so you're gonna trail it bar by bar on the hourly or daily time frame if you're swing trading. If you're day trading, it becomes a lot trickier because You can either choose to trail it on either the 1 minute or the 2 minute chart, or you could also use the 5, 15, or hourly time frame. You have a lot of options when it comes to trailing it if you're day trading, right? If you're looking for a tighter trail, right, and what that means is you're looking for tight stop losses. It's more likely to secure profits as soon as possible without giving the trade as much room to operate by using lower time frames, right? Because on lower time frames, the candlesticks are a lot smaller. There are a lot more of them, right? It's a lot more likely that that's going to hit your new stop loss if you're trailing it on the 1 or 2 minute time frames. Okay, but if you want to secure profits as soon as possible without giving the trade, right, room to fluctuate, then use lower time frames. However, if you do want to, let's say you found a stock or a crypto and you're extremely confident that it will continue higher, but you also don't want to get shaken out easily. If you're really, really confident that it's going to continue higher, then use larger time frames to trail, where you could even use the hourly or perhaps the 15-minute time frame, okay, if you're day trading. Okay. Also, let's talk about this concept here. The speed that it hits target matters, right? Like, let's say you have a base breakout. You have a base and you're playing a base breakout. If this immediately pops into your target, right, as opposed to, putting in a gradual move to your target, you're going to want to take at least 50% of the profits that you made in that trade, right? If this immediately pops really fast to your target, you either want to take at least 50% of your profits, or honestly, you might want to just take all your profits and don't even trail the position. Just take all of your profits, right? Because quick, large, and sudden moves higher could also lead to quick and sudden moves lower, okay? And the last thing you want to do is have the position immediately reach target, right, really fast, and then you're like, oh, but maybe I want to go for a higher target or whatever. You want to keep this trade because you think it's going to go higher. The last thing you want to do is the last thing you want to do is stay in and have this stock completely fail and go right back down. Okay, so if it's a really fast acceleration into your target, take profits, right? At least 50% of your profits, okay? And understand that context matters. And this doesn't only apply to trailing, this also applies to setting stop losses from the beginning of your trade. When determining how to manage your positions, make sure you look at how the overall stock or crypto is moving, right? If it's whippy or if it's sloppy or if there's a lot of tails, right? Whether it's bottoming tails or topping tails, make sure you give that trade more room to fluctuate. In other words, set a little bit larger of a stop loss, okay? And yeah, you might minimize your reward to risk, but at least you won't get shaken out. The last thing you want to do is get shaken out of a position that makes a huge move in your favor. And understand, guys, like I mentioned earlier, trading management is difficult. It's an art, not a science. Once a trade is working in your favor and it's hit your target or you're making good money on it, and you want to start managing that position and making sure you maximize your profits while securing some profits in case the trade ends up failing after all, then you got to really kind of try to master what works for you, what trade management style works for you, okay? And over time of developing experience, like I say, you're going to find different trading management strategies that work best for you. Every trader is different and unique, okay, guys? So hopefully this makes sense, all right? I'm going to have one last sip of my coffee, so cheers to you guys. Okay. So if you're kind of confused on this, understand that it's normal, okay? This is kind of a difficult concept. So make sure you come to my live streams. Make sure you ask me questions on how you can master this. But the general idea here, just to give you guys an overall summary of what's going on, if a winning trade, right, hits your target, you could either take all the profits, right, and just take the position, liquidate the position, take your profits, or you could trail the position, right? And by trailing, you're going to be raising your stop loss to either a new pivot low, or maybe under the lows of the new base that was forming, or perhaps you're going to trail it bar by bar, where as soon as it hits target, you place your stop loss under the most recent candlestick. Okay, so whichever way you do it, make sure that you're kind of experimenting with it, because you kind of, like I said, you have to find something that works for you. And last thing I want to emphasize here, last thing I definitely want you guys to really get this. If you enter a position and it fails and it goes against you and it hits your stop loss, exit every time. Always respect your stop loss. And if you're share sizing correctly, right, by calculating, right, risk dollar amount divided by the size of your stop, right, that will give you your share size. If you're share sizing correctly and you're respecting your stop losses, you're never going to lose more money than you intend on losing, right? If you're the maximum amount you could lose is $100, then through share sizing, through risk management, and through following and being disciplined with your stop losses, you're never going to lose more money than you intend on losing. So this should be a rule. This should be like a golden rule. If it hits your stop loss, exit the position. Don't let it go more and more against you. And to do that, honestly, my recommendation is as soon as you place a trade, don't do mental stops. Just put a hard physical stop into your broker, into your exchange. Just place the order where, once you're in the position, place your sell stop loss order at whatever the price it is. And if it hits your stop loss, the system, your broker, your exchange will immediately take you out of the trade. In that case, you're not going to lose more money than you intend on losing, therefore limiting your losses. I know this was a lot of information. I know I'm talking a lot, guys, but I understand this stuff is difficult. That's why I'm really trying to, give you guys enough context and really explain everything very thoroughly. Okay, I hope this makes sense. See you guys in the next class.
In this chapter, we're going to combine everything that you've learned in this free course so far, and I'm going to help you build a trading plan. And building a plan as a trader is vital because as traders, we hate randomness. We don't like taking random trades with random risk, with random management. Everything we do needs to be structured and predetermined. And the only way to do that is to have a predetermined trading plan. So let's not waste any time and let's help you build that plan.
What's going on, guys? Hope you're having a great day. We are approaching the end of the course, and now our goal is to create a trading plan. Okay, every trader needs a plan, and this doesn't really only apply to trading. If you want to be successful in anything, you need to approach it in a systematic way. You can't have random decision making. You have to have a plan, and you have to execute that plan. After you execute that plan, you have to review it and refine the plan and continue forward. Okay. Everyone's trading plan evolves over time. All right. So today I'm going to be helping you create your own trading plan. And I'm going to be talking about how I created my trading plan back when I started trading. And even though I have 3 years of experience now, I make money basically every single day. I still don't deviate from my plan, and I still refine my plan over time, even though I'm already profitable and I'm already, experienced. So this isn't just for beginners. Even if you're, a profitable trader already, you could still find value in this class. So let's go ahead and begin. So building a trading plan. Why do you need a trading plan? So like I said, guys, to succeed in any endeavor, especially trading, you need to have a plan. You need to have a list of actions that you have to take and a list of rules that govern your behavior. And with a plan, you're going to be trading in a consistent and systematic way with no random decisions. As traders, we want consistent profits. We're not going to be able to make consistent profits unless we're operating in a consistent way, right? If we're consistently doing the same things, then we're going to have some sort of repetitiveness in our trading. And especially if we're doing the right things consistently, we're oftentimes going to make money consistently, okay? But how can you expect to develop or develop as a consistent trader, consistently profitable trader that is, if you're doing random things every day? You have to remove the randomness from your trading. And as soon as you remove that randomness and you're trading in a predefined way, you're going to notice your consistency and your results start to improve almost immediately. So over time, you're going to be adjusting your plan based on what's working, and you're going to eliminate from your plan what's not working, okay? So in the beginning, I would really suggest to start with conservative, smaller goals and create strict rules. Create strict but easy to follow rules, I should say, right? And with a plan, guys, you're gonna be accountable for your actions. And there's gonna be times in your trading career where you go against your plan. It's happened to me. It's happened to every trader where you have developed a plan, but then you go against it and you lose money, or perhaps, you don't do the right thing. And that's going to be an ego hit. You're going to say to yourself, wow, why did I lose this money? It completely went against my plan. It completely went against what I planned for, yet I still did it, and I lost money because of it. And, it's going to feel bad. You're going to have an ego hit, but that's a part of the journey. You're inevitably going to, kind of go away from your plan and take stupid trades and make stupid decisions, but that's a part of the growth process. But with the plan now, you're going to be accountable. You're going to have some sense of responsibility where you don't want to disappoint yourself and take trades that go against your plan and go against your predefined reasoning. Okay? So what we have to understand now is every trader is different. Every trader must trade to his or her own personality. So what that means is you could take 10 successful traders, put them in a room, 10 random really successful traders. And if you look at each of their strategies, right, and how they make money, you're going to notice that they all make money in completely different ways, right? And they trade based on what works for his or her own personality. Everyone is going to have a different style. What I like to trade, excuse me, you're probably not going to have an affinity for that sort of trading. Just like what makes sense to you, what trading setups work for you, and how you like to trade, that's not going to work for me. So your goal through this entire learning process is to slowly figure out what works for you. What style do you want to adopt? It's totally okay in the beginning to kind of copy someone else's style as you're learning, but you're going to quickly notice that if you don't resonate with someone's style, right, it's the trades are not going to make sense to you. And you have to find maybe one of our analysts, find what analyst style works for you, what resonates with you, what makes sense for you, and start taking his trades. And then over time, you're going to be taking your own trades that work for you. So play onto your individual strengths. So let me give you an example, and I'll give you my own example. When I started trading, I was going through the process of figuring out what works for me, what I like to trade, what's my own style. And knowing my personality, I'm a very high energy, I don't want to say I'm impatient, but I'm high energy. I don't like to lose money, right? Like I know losing money affects my psychology. Sitting and seeing myself losing money affects my psychology. I know that, for example, like I said, I'm high energy. I'm kind of like a twitchy guy. I'm always moving, right? And I've developed a trading style that kind of fits my own personality where, excuse me, I'm less of a patient trader and I'm more of a scalper. I'm more, kind of get in and out of positions. I go for quicker profits than most, but I do that a lot of times, right? And you might be thinking and hearing, myself talking about it, and you're like, oh, I'm actually a patient person. I would never want to just take profits right away. Well, there you go. Now you know what style, you have to adopt. But for me, that's what works for me. And I was able to figure out that very early in my trading, and then play on to my strength, right? Develop that strength of mine, because I'm really good in high pressure, quick situations where other people are better in, very low pressure, letting the trade play out over time, giving it the room to play out. For me, I like to do high share size in high pressure environments where it's really quick in and out scalps, right? Quick in and out, getting in the trades, getting in, entering really fast, exiting really fast. That's just what I prefer. It's what fits me, and I play to that strength. So building a trading plan, the first thing you want to do, guys, and we've talked about this before, is figure out your risk, determine your risk. Figure out what risk you're comfortable with losing. If you're a beginner, even if you're like an intermediate trader, my recommendation is risk low amounts, focus on consistency, okay? And I can't emphasize this enough, but even if you're paper trading, use the same risk and try to make it as realistic as possible. I paper traded for 4 to 5 months before I started trading with real money, but I didn't play around with paper trading, right? Like, I didn't just treat it like a video game. I really tried to, go into it and paper trade as if it was real money. And because of that, and when I lost paper trading money, I felt bad about it. I kind of had the same reaction as if I lost real money, right? And I had to force myself to really I want to think about it like it's real money, because that will actually prepare me for what I'm actually trading with real money later down the road. So even if you're risking $10 to $20, right? Like if you're just beginning, risk $5 a trade, $10 a trade. And that risk, that's the maximum amount you could lose on that trade. Risk a low amount, $5, $10, even $1, like who cares, right? Just start developing the right habits with low amounts of money. And my recommendation is paper trade, okay? Paper trade. And when you're paper trading, they're going to give you, like in your account, since it's fake money, they'll probably give you like $1 million to paper trade, right? Don't use that. Make it realistic. Think about how much you're actually going to be trading with when you're trading with real money, and then paper trade to that account size, right? Like if you're only going to have a $1,000 account size, when you're paper trading, assume you only have $1,000 to paper trade, and practice realistically, risking realistic amounts of money. Like if you risk $200,000 and you make $100,000 on paper trading, you're like, oh wow, I made $100,000. Like imagine if it was real money. You would have never done that if it was real money, because with real money it comes with risk, right? And that's going to affect you. You're not going to be risking $200,000 on a random trade, right? So take it seriously. Rule: never deviate from your risk. Never deviate from your risk. Never increase your risk randomly. Never just, if you set $10 as your risk, don't randomly increase it to $20 or to $30. Okay. So let's talk about strategy requirements. You should only be trading when you see a distinct strategy that we learned here. Don't trade random setups. Don't make random decisions. For each strategy, what you want to do is create a little template of requirements of what the stock or crypto must have. So here's just an example. You want to have the pattern. I chose the buy setup. You want to have a must have and a cannot have. And this is just an example, okay? So must have, if it's a buy setup, established uptrend, okay? Rising 20-day moving average, multiple time frame alignment, 40 to 60% retracement. Your must-haves might be different than mine. Maybe you're a lot more of a strict trader and you want to include all the other conditions we talked about for the buy setup, right? If you don't remember, go back to the buy setup class. But this is just an example. So this is what you want to have. Must-haves, right? And then cannot haves, where if it's, let's say there's no market alignment, don't trade it. If it's a deep or shallow pullback on the buy setup, don't trade it. If there's large amounts of resistance above the buy setup, meaning there's limited targets, don't trade it, right? So this is a little template you want to have for every setup. All right, guys, sorry, the stream actually cut off, so we're going to continue on here. So the whole point of what we're doing here is we're creating a template where we have must-haves and cannot-haves. So what you do is once you have your template created, you can go back to my classes to figure out the exact requirements. What you do is, you write this either on your computer or on a notebook, and whenever you're, finding a trade, let's say you're on your charts and you see a buy setup, right? You see a buy setup or a potential buy setup, and you go to your charts and you say, okay, does this have an established uptrend on multiple time frames? Okay, it does, check mark. Does this have a rising 20-day moving average that's trending under price? Okay, it does, check mark. Does this have multiple time frame alignment? Do we have confirmation on the other time frames that everything looks bullish? Okay, we do, check mark. How's the retracement looking? Okay, check mark. Very good. How's the pullback looking? Do we have an entry bar? Check mark. Okay, great. Do we have a tight stop loss with good reward to risk? We do, check mark. Okay, does it have, now let's see what it cannot have. Does it have a deep pullback? No. Do we have good targets? Or do we have bad targets? No, we have pretty good targets, right? And you're gonna go down the list like that. And if the buy setup matches all of your requirements, or most of them at least, right? Like it kind of depends on you how picky you wanna be, then you take the trade. And if it's let's say a breakout, you do the same thing. You look at your template, right? And if you're wondering what should I have in my must-haves, what should I have in my cannot-haves? Well, you have to look at the class, look at my classes, and create a plan. And just look at the requirements and make a template like that, okay? So that's kind of the work that you guys have to do. Let's talk about entry requirements. Only enter a trade that has a distinct entry point based off what strategy you're trading, right? If it's a buy setup, you know where the entry is. It's above the entry bar. If it's a breakout, it's above the highs of the base. If it's a climactic move, then, it's above or below the entry bar, right? So make sure you have a distinct entry and maybe put that in your trading plan. I have to have a distinct entry. I'm not entering randomly. I have a distinct entry. Place the stop loss exactly where you should for the strategy you're playing, right? You know where to set your stop losses for each strategy. Make sure you have an exact price that you're setting it. It's not random. Okay, it's distinct. You know what price you put it into the system, right? You're setting your stop losses in the system. If it hits that stop loss, you're out of the trade. No questions asked, right? And you can make that a rule where if it hits your stop loss, you're out of the position, right? You're not going to allow it to go against you more than where you placed your stop loss, right? If it approaches target, you look to take profits or you trail the position, right? So building a trading plan, let's talk about protecting profits. So this is a really important idea. And this, I've seen successful traders completely lose their confidence and lose their mojo just because they fail to do this. Let me give you an example, right? Let's say I made $1,000 on the day, or let's say you made $1,000, right? So you're up $1,000. You have to ask yourself, how much am I willing to risk now, right? Like if you're already $1,000 in the profit, are you willing to lose all of that $1,000 where you're gonna end up finishing with zero? Like you want to protect some of the money you made on the day, right? So let's say you have $1,000 and you say to yourself, okay, I want to protect at least 800. I can't lose more than $200 on this trade. I have to protect 800, right? If you're at 1,000, I have to protect 800. I'm not willing to lose more than $200, okay? Because 1,000 minus 200 is 800, okay? So in that case, you put that in your plan, right? You have to protect 80% of the profits you made on the day once you hit a certain target or something. So if you risk $50 per trade, $50 is one risk unit or 1R. So one risk unit is whatever your maximum risk is. That's 1R. In this case, it's $50. Remember, we talked about that we always want to have 2-to-1 reward to risk. In other words, two R's to 1R, or $100 profit at least for $50 risk. So here's one strategy you could do. If you're up 5 Rs in the day, you have to protect at least 4 Rs. In other words, if you're up $250 in the day, right? Because 5 times R, 1 R is $50, that's 250. You must protect 4 Rs, which is 4 times 50 is 200. So you have to protect $200 if you made 250. This is one strategy. And let's say you're in an open position, you're in an open trade, and you are up 2 Rs. You have to either trail to break even or trail to secure some profit with the management strategies we've already discussed. So the whole point of this is, let's say, it hits your target, you're up already 2 Rs on the position, which is, that's what we want. We want at least 2-to-1 reward to risk. You can't lose money on that trade. Either trail it to break even or trail it in a way where you could secure 100% some profits, right? With the management strategies we've discussed, or just take profits completely, right? It depends on you. So let's talk about some rules that you have in your trading plan. At the end of the day, guys, it's all about the rules. It's all about the discipline, right? It's all about following these rules, staying disciplined, okay? That's in each rule, everyone's list of rules is going to be different based on your own psychological flaws. You have to figure out what is standing in the way of your trading from really taking the next step, what psychological flaw specifically, and then create rules addressing that flaw. So I kind of listed a whole list of examples. So if you lose X number of consecutive trades, you step away or lower your risk. If you lose 5 trades in a row, lower your risk from $50 to $25 until you gain your confidence back, or just step away from trading completely for the day. If you lose 4 Rs after being up 5 Rs, stop trading for the day. So let's go back to this example. Let's say you're up 250. If all of a sudden you lose 4 Rs, so you lose $200, and now you're only up $50 on the day, you lost 4 Rs, step away, okay? You don't want to snowball the losing. I think a lot of traders, actually, I'm going to make this point after we get through all the rules real quick, because it's kind of an important one. But so predefine your risk and reward for each trade. Before you enter each trade, make sure you know what your risk is, where the stop loss is, where the entry is, what target you're looking for, and make sure it's predefined. You know the exact prices of your target, your entry, and your stop loss. Another rule, and this is more of like a guideline, you're trading to acquire skill, not to make money, okay? Don't worry about the money. Worry about you acquiring the skill. If you focus on acquiring the skill, the money will come, I promise you. I can guarantee you, if you're focusing on the skills and learning how to become the best trader you can, the money will come. I guarantee you, and it will come in spades. Okay, you will make a ton of money. The fact is, trading is not a linear process. Success is often not a linear process, right? You're usually kind of, I can't really draw it, but usually your success is kind of flat, flat, flat until it goes exponential. Okay, so just focus on developing consistency, focus on becoming a better trader. I promise you the money will come, and a lot of it will come as well. If you feel emotionally compromised, step away and lower your risk. If you're trading and you start to feel that you're trading off emotion, step away. Okay, that's a big rule for me. Don't make random decisions. Every decision should happen for a reason that you can justify. Okay, don't have any outside beliefs. You only listen what the charts are telling you. That's a big point. I'm probably going to make a separate class on that, just to listen what the charts are telling you. Understand, like I said, you guys are going to have different rules based on your psychological flaws. Every trader is going to have different rules. You have to figure out what set of rules fits you. Okay, so that's really key. Okay, and guys, you have to understand that in the beginning, don't be focusing on creating a perfect trading plan. There's no such thing. Your plan is inevitably going to evolve over time. So what your goal is create a plan, right? First, Determine your risk. Then make a little template like this for every trading strategy you're looking to play. Then create some management rules, right? When are you going to take profits, right? How much profits are you willing to get to sacrifice if you're in a trade, right? How are you going to protect your profits, right? All this stuff. Create a plan at the beginning and make it simple, right? Just make a beginner's plan. Then execute. Go in for 2 to 3 days or 4 days, maybe a week. Execute that plan. Record every single trade you take. And at the end of the week, you're going to go back and review every single trade that you took, or maybe you could do this on a daily basis as well. Review every single trade that you take and see where are my mistakes, right? Where do I need to improve? What am I really actually doing wrong, right? And if it's a question on, okay, I'm taking bad setups, then review and be like, okay, what makes this a bad setup? What would a manual say, right? And if you're confused, that's what the live streams are for. Come to my live streams and ask me questions, right? And I'm sure you could I could help you a lot with helping you evolve your trading plan, right? And after you review, right, you're seeing what you're doing wrong, you refine, you fix up your plan, you change your plan, you make some adjustments. And then what do? The next week or the next day, you execute again. Then you review, then you refine, then you execute again. You review, you refine. And this is a process that will take time. And you're going to notice all of your negative habits from your trading are slowly going to go away. And guys, in trading, it's really it's not about what you are doing in trading. A lot of the times it's about what you're not doing in trading, what you don't do in trading, right? Like if you minimize all of your stupid mistakes, all of your psychological flaws that are leading to unnecessary losses, if you eliminate all the garbage that you do in your trading, right, you're going to become more profitable. Like for me, guys, personally, when I was first starting out, my number one goal wasn't to make money. It was just to figure out what I shouldn't be doing. What should I stay away from in trading? And once you understand what you should stay away from in trading, what setups to stay away from, what charts to stay away from, right? What maybe psychological mindsets you should stay away from, right? Once you know what not to do, it's really easy to flourish in what you're supposed to do, if that makes sense. Just focus on what not to do, eliminate all the stupid garbage from your trading, and you're going to see your trading go to the next level. Okay, that's really it for the presentation, guys. Just understand that this is an evolving plan. And I think we talked about, guys, just go step by step here, follow everything. I really want to emphasize that at the end of the day, everyone's different. Okay, everyone is completely different. Your plan is going to be different from someone else's plan, but always create a plan. Do not procrastinate. Put it pen to paper, write it down, and think it through. Stop trading randomly. Make this plan and execute off your plan. Okay, don't procrastinate. Write it. After this class, take out a piece of a notebook, get a pencil or a pen, write down your plan. Okay, and once you do that, you're ahead of the 95% of traders, the 95% of all the amateurs who don't know what they're doing. You're going to be ahead of them because none of those guys have a plan. They're trading randomly. They are effectively gambling like at the casino. Why? Because they're not doing anything consistently. They don't have a plan of execution. They just do randomness. And I can guarantee you, if you're just going to be a random individual, a random trader, you're not going to ever consistently make money, which is the goal. All right, guys, hope this makes sense. Please come to my streams if you have any questions. See you later, guys.
I'm going to teach you how to build a trading plan so strong that you have no choice but to become profitable. And I guarantee that 90% of the people that are watching this video right now, and yes, that includes you, are approaching the markets randomly. Random setups, random strategies, random management, random execution. And the funny thing about that is you have random input but you're expecting consistent results. It makes absolutely no sense. And by the end of this video, I'm going to teach you how to build a trading plan specifically tailored to you so you could 2x, 3x, even 5x your trading profits. And it doesn't matter if you're trading on a small account or a large account or what market you trade in. It doesn't matter if you trade stocks, options, futures, crypto, Forex. This video is going to save you hundreds of hours. And if you actually apply what I'm teaching you, it could dramatically increase the amount of money that you're making in your trading. And before we get into the video, I want to go ahead and introduce myself to anyone who is new to me or new to the channel. My name is Emanuel Malyarovich, and 5 years ago, my father taught me how to trade. He was my mentor, and without him, I would not be where I am today. And in fact, this picture was literally day one of him teaching me how to trade. My mom took this. This is where it all started. And if you want more information about our journey, obviously from my perspective, but also from my dad's perspective, and if you want to know my dad's journey as well, I created a YouTube interview video with my dad where he details everything, what he had to go through to become profitable, and of course how he taught me. So after you're watching this video, I would highly recommend watching this one. It's on the same channel, so definitely check that out. And here are my last 5 months of trading statements, and the reason I'm showing you this is to be as transparent and as real as possible. I use Charles Schwab, that's my brokerage account, and I use Thinkorswim platform. I want to show you that I actually make money doing this, that everything I'm going to be teaching you today, I actually implement within my own trading to make money. This is what I do full time. This is my career. This is how I make a living, and I trade live every single day. So in this statement, you'll see my deposits. I didn't make any deposits. You'll be able to see my withdrawals, my beginning balance, ending balance, cash activity, all that good stuff. In November, I made $77,571. December, I made a little bit over 53K. January, I made 73K and then $656. February, I made a little bit under 69,000. And in March, I made a little bit under 44,000. And it is currently April 27th. I'm going to have my April statement ready for next video next month once that statement is prepared. But I think I'm up a little bit over $57,000 for the month of April. Hopefully a little bit more. There's still a couple more trading days. And by the way, I post my profits every single day on my Instagram, mtrades, and I give you kind of like a sneak peek of my life as a trader, and I try to be really transparent. So definitely follow up on my Instagram if you want to know kind of day to day what I'm doing as a trader and how much I am making. But let's go ahead and jump right into the video. I want to keep this video around 20 minutes long or so I have a shot clock, 20 minutes on the clock. Let's get this going. Build a trading plan so strong, it's impossible to lose. And when I say it's impossible to lose, I'm not talking about that you're not going to have any losing trades. Losing is inevitable in trading. It's a part of the profession. You're going to have losing trades. All of the best traders have losing trades, but I'm talking about impossible to lose long term. To build a plan, to build a system that can make you money in 1 year, in 5 years, in 10 years. And you need a plan in order to do this. And it blows my mind how many beginner traders don't put any attention to building a profitable plan. Every serious profession where money and risk are involved, a plan is required, a pretty intricate plan, right? Why would trading be any different? I mean, think about it. If you're an entrepreneur, if you're a business owner, you create a business plan, right? You have a marketing plan, marketing budget. You know exactly how much you're going to be paying your employees. You have a strategy for how you're going to scale your business, right? You can't, start a business and expect to make money without a plan. Trading without a plan is like starting a business with no idea how you'll make any money. It doesn't make any sense. If you're starting a business, you need a plan. If you're going to be a trader, you need a plan. Pilots have a flight plan, right? When you go on a plane, you're not hoping, I hope my pilot just flies and hopes that he lands, at the right spot. No, they have a clear flight plan on how they're going to fly, what altitude, whether there's going to be crazy weather conditions, if there's going to be a storm. And trading without a plan is like literally flying without a blindfold. It sounds ridiculous, right? But trading without a plan is also ridiculous. Next, engineers and architects create blueprints, right? Before they even start constructing the building, they have every single detail completely planned, right? Because without that, well, the building would inevitably collapse or it wouldn't be properly built. A lack of a trading plan in that sense could lead to an emotional collapse. Just like not having a plan if you're constructing a building could lead to the building collapsing, right? Does that make sense? We need a plan. This is something that you need to be focusing on right now. It's extremely important because your job isn't to trade. Your job is to follow your trading system. And your trading system is built through time and experience. And I'm going to show you how to build one literally today. So let's go ahead and literally create a trading plan together. So what goes into creating a trading plan? What's the first step? So number one, strategy requirements. What is your edge? What strategies or setups are you trading? What is your methodology? And I'm going to be going over a strategy today, but I highly recommend watching my free 10+ hour course if you don't have any strategies or you don't have a methodology or you don't have a foundation behind your trading. My free course, it's in the description of this video. It's genuinely better than most paid courses on the internet. So you could use the free course in conjunction with this video. But what should your strategy actually have, right? So number one, you cannot trade random setups, right? That's not what we do as traders. Nothing in our trading should be random because guess what? Random actions lead to random results. And we don't want random results. We want to be consistently making money with trading. You're only as profitable as you are consistent. So in order to get consistent results, you need to have consistent actions, consistent input. And in order to have consistent input, you need a plan, right? So what is your edge? You have to think about that. Like, what's your methodology? Why are your strategies going to work over the long run? They need to be defined. They need to be repeatable. They need to be identifiable. So when you look at a chart, you know what you're seeing, and the same setups will make you money over the long run. And you need to have a template of the requirements that you need, the criteria that you need to see for a trade, right? There are low quality setups and there are high quality setups. There are specific criteria that make a setup high quality, and then there are also, or I should say, a lack of criteria that make a low quality setup low quality. You need to know all of this criteria. You need to know what specifically goes into a high quality setup. And we're gonna do that right now, right? We're gonna do a little bit of a sample little plan, all right? So what we're gonna be talking about is a buy setup and retracement. That's the strategy, right? So in your plan, you have the strategy listed, and then you wanna have a template of the criteria that you need to see in that setup, the criteria that you would like to see in that setup, and specific cannot haves, which will literally restrict you from doing the trade in the first place. So what is a buy setup? That's like a retracement pattern, right? A buy setup it's kind of like buying the dip, right? It moves up and it retraces. It's one of the most simple strategies out there, and it's actually one of my primary strategies. I keep my trading extremely simple. I don't have fancy strategies. I don't have fancy, the liquidity divergence on the 15 ICT time frame creates an RSI Bollinger Band speculation. Like I keep it simple. I use like 2 moving averages and that's it. All right. So buy setup, retracement, buy the dip type of setup. That's what we're talking about. So must have. What do I need to have in my buy setup? And by the way, as we're constructing this plan here, you don't need to have everything that I have, right? This is just an example. You can move bits and pieces around based on your own psychology, based on your own preferences, based on your style. This is just a framework on how to create your plan, right? So you don't need to copy me. You can take what I'm doing and apply it in your own way to your own system. So for me, in order to trade a buy setup or a retracement, I need to have a rising 20 MA and I need to have an entry bar. Now, I have here kind of a diagram of a really almost picture perfect buy setup or retracement pattern. By the way, I teach all of this in my free course. So if this is confusing, I would watch the free course. This is going to teach you all of these criteria that I'm about to talk about. So rising 20 MA requirement, I have the rising 20 period moving average, under price, trending higher. Check. Entry bar. For my entry bars, I either want a doji bar or a narrow range bar. Those are kind of like my requirements for the setup. I must have these two in order for me to take the trade. I need 3 or more consecutive red bars in a row on the retracement. So red bar, red bar, red bar, red bar. Or red bar, red bar, red bar, green bar. 3 in a row or 4 in a row. What I don't want to see is red bar, green bar, red bar, green bar, red bar, green bar. I don't want to see Christmas lights. I want to see consecutive red bars in a row. I need to see that. That's a part of my must-have. 40 to 60% retracement. So prices moved up, and then we got a 40 to 60% retracement, which is like between probably here and here. So did we retrace into this 40 to 60% area? I call this the golden zone, the golden retracement zone, right? 40 to 60% retracement is great because if it's over 60% of a retracement, well, it's a little bit too weak. Why would we retrace over 60% if this was actually bullish and if this was a legitimate uptrend? And if it's below 40%, let's say it only retraces like 10 or 20%, well, it hasn't corrected enough. We need to see more of a dip before I'm going to be interested in playing the uptrend or playing the buy setup, right? So there's like a golden zone, 40 to 60%. I need to see that. I don't want to see deep retracements. I don't want to see shallow retracements. So these are my must-haves. Next, I want to see an interesting overnight gap, right? I trade gapping stocks. I trade stocks that had overnight changes in price. I have another video that's explaining that. So I would watch my morning routine video, and I would watch the my boring strategy that makes me 50K a month video. Those will kind of go into overnight gaps and how they work. I also want to see 2-to-1 reward to risk. I need to have 2-to-1 reward R to R. If I risk $100 on the trade, I need to be at least making $200, right? So what are these must-haves? These are criteria that I need to have for me to trade this setup. If I don't have these must-haves, I don't trade the setup. That's, what's great about having a plan, because I know what I'm looking for. Like, it's in my mind, but I can even write it down. I know exactly what I'm looking for. So when I see a setup, I can look, hey, does this fit my must-haves? And if it does, great. If it doesn't, then I can't take the trade. Now, I also would like to have retracement into minor support. This is like when you have an uptrend and the previous high becomes support for the next pullback, right? So I'm going to see if I can kind of draw this here. Pen, all right, the pen is kind of, so it's kind of thin, but let's say you have an uptrend like this, you get a pullback, you get another move higher, and then you get a pullback, where this pullback essentially pulls back into this previous high. So all of a sudden, this prior resistance becomes what's called minor support for the stock, and this is where we would want to go long, right? So I'm not going to go too deep into that, but that is minor. That's a retracement into minor support. I would like to have 3-to-1 reward to risk. I would honestly like to have 4-to-1, 5-to-1 reward to risk, but my must-haves says I need at least 2-to-1, but I'd like to have 3-to-1 or 4-to-1 or 5-to-1, right? Volume requirement. We tend to want to see a volume spike on the actual trigger of the buy setup. So when this candlestick finishes, or when this candle takes out the entry, right, which is over the highs of this entry bar, I want to see a volume spike. They're showing that the buyers are stepping up to the plate and buying this stock. All right. I also want to see market alignment, relative strength to the market. I love to see when the market is dropping. I love to see stocks that are basing at the highs or are within an uptrend, because then it's showing relative strength to what the market is doing, right? The market's pulling back, but this stock is holding strong within its uptrend, and it looks, it's showing relative strength, right? There's something unique about that stock that's causing it to not drop with the market. I'd love to see that. Or market alignment, where let's say the market is pulling back, getting ready for a buy setup retracement pattern. Maybe the market is at this point right here before it continues higher. I can time my entry into the stock that I want to trade with the market triggering higher, with the market triggering on the buy setup, right? I also ideally want to see a readable level 2, which is order flow. Not going to go too deep into that, but ideally I want to see a really good level 2. All right, cannot have. I can't have conflict within the time frames, right? I can't have the 5-minute chart look in a downtrend, 15-minute in an uptrend, hourly is sideways, daily is bearish, right? There's no alignment among time frames. If there's conflict between time frames, I don't take the trade, literally ever. All right, so very, very important. Next, I don't want it to be sloppy, and I don't want it to have high spread, right? No high spread, no sloppiness. And if it's under 2-to-1 reward to risk, I do not take the trade. So this is a really good framework of what I look for in a buy setup. And here are some really good examples of buy setups, right? We moved up 40 to 60% retracement, a bunch of entry bars, 2-to-1 reward to risk, entry above the highs here, stop loss here, right? What other criteria does this match? The overnight gap, there wasn't an interesting overnight gap. We got 3 consecutive red bars in a row. We did have 1 green bar, but that's not too big of a deal. And of course, we have the rising 20-period moving average requirement. Perfect. Next, right here, we moved up. We kind of retraced into the rising 20-period moving average. Beautiful follow through. Pullback, 40 to 60% retracement. Entry bars right into the rising 20 MA. Entry over these entry bars, stop loss below. Maybe this didn't have quite 2-to-1, but you guys get the idea. These are really good setups based off the criteria that I like to see for a retracement pattern. This is just a sample of what you can do. Next, the next criteria within our trading plan is determine your risk. What is your risk? That is the maximum amount that you could lose on a trade. That is your risk. You don't lose more than your predetermined risk. And that's the important word here, or 2 words, predetermined. You don't like guess what your risk is going to be when you enter a trade. You know the worst possible outcome of that trade before you get into it because you know what you're risking, right? So what risk are you comfortable with losing? You have to pick an amount where you're comfortable with losing it. It's not going to affect you emotionally or psychologically, but it's also not low enough where it's like you don't even care. Like if I risk $10 on a trade, I don't care. But if I risk 500, which is what I do, $500 to $600 on a trade, it's not going to really impact me if I lose it, but I'll feel it, right? Like it's not high enough where it's going to affect me, but it's not low enough where I'm going to dismiss it. All right. Before you enter a trade, you have to accept the risk that that trade may not work out. Very important. You always have to accept the risk, right? Because losing in trading is inevitable. It's not about being right or wrong. It's about having high probability strategies. And then over the long run, if you take enough of those high probability strategies, even though some of them are going to lose you money, over the long run, it'll ultimately make you money, right? With a large enough sample size. But in order to do that, you have to accept the risk that you take on every trade. You're okay with losing the amount that you're risking. If you're paper trading, I recommend risking the same amount that you would use with real money, just to keep it as realistic as possible. And if you're a beginner, risk $1 to $10 per trade. Risk extremely small amounts because guess what? If you can't be consistently profitable risking small amounts, you're not going to be profitable risking large amounts. Develop consistency. Develop your feel, your intuition on small risks. So even if you make mistakes, even if you experiment, even if things go wrong, you're not losing a ton of money. Focus on the consistency. And then once you're noticing that you're becoming consistently profitable, everything is coming together, that's when you can begin to scale your risk. All right. Next, guys. So trade management. So a lot of people, they think that getting into the trade is the most important part. That is not the case. That's like literally 25% of the battle. The other 75% of the battle is managing, while you're in the trade. That's the entire thing. Like your in-trade management is what's most important to make sure you extract as much value from that trade as possible while keeping your downside relatively low. All right. So you need to know how you're going to manage the trade before you even enter it. You need to know when are you going to take profits? Do you have a specific target? How much profits are you actually taking? Are you going to leave a runner on the position? Are you raising your stop loss at any point to break even or to a specific point on the chart? If so, when are you going to do that? Like if you hit a certain reward to risk, if you're up 2 to 3 Rs on your position, are you going to raise your stop loss? How much profits are you going to take out, right? If you hit 2 to 3 Rs, Are you going to take out 100% of your profits or 50% of your profits, right? All of these trade management concepts you need to have predefined, predetermined within your trading plan. So when you're in the trade, you don't need to guess, how am I going to manage this trade? When do I exit? When do I raise my stop loss? How do I manage it? You don't do that. You know exactly what you're going to do before you even take the trade. Now, as you become more and more experienced, this is going to become more and more discretionary, where you can literally make like in the moment type of decision where you're managing a specific trade and you can make an impulsive decision based on the management, right? Now, that's once you have experience, you can kind of do it on the fly, like myself. Like I have a trading plan that I do, but a lot of my decisions are discretionary. But in the beginning, you have to keep it systematic. I'd recommend writing on a piece of paper. And then once you get a feel, once you develop intuition and experience, you can go more discretionary and you'll know your style. You'll know what psychologically you like to do, right? So let's create a little bit of a sample trading plan here for you guys, so you guys know, you guys know the structure of what to actually do. We're kind of running low on time here. We're at 2 minutes, but whatever. We're gonna make this video a little bit longer for you guys. So if you're below 2-to-1 reward to risk on the position, you're gonna stick with your original stop loss, right? So let's say you get into the trade and it's moving in your favor, but it's below 2-to-1, right? In that case, just stick with the original stop loss, right? And by the way, you don't have to do this, right? This is just a sample. This is just a framework. This is just me trying to teach you how to think. From here, you need to create your own that will fit your own psychology, right? But let's say you get into a trade, it's maybe 1-to-1 reward to risk. At that point, you just stick with your original stop loss. Or you could raise your stop loss to break even. That's another option for you. You hit 1-to-1 reward to risk, raise stop loss to break even. That's an option, right? And let's say the trade doesn't work out, it doesn't even go in your favor, you get out at your stop loss. That part of management is actually really easy. If it's a losing trade, it's incredibly easy to manage because you just stick with your stop loss. If it's a winning trade, that's where it gets difficult because you want to extract as much profit as possible. So under 2-to-1 R to R, stick with the original stop loss, right? You could do that. If you hit 2-to-1, right? Let's say you're risking $100, the trade is now $200 in profit. What you could do is take 50% of profits. You take $100 off the table, you move your stop loss to break even, and then you trail the back half of your position. And there's a bunch of strategies that you could use to trail your trades. Trailing just means raising your stop loss when you're in the position. I would just watch my free Temple Sour course. It'll teach you how to do that. So this is an option for you. Or at 2-to-1, you could take 100% of your profits. Or at 2-to-1, you could stay completely in the trade and just move your stop loss to break even. It's up to you, whatever you want to do, right? This is just a framework. Next, let's say you're up more than 2-to-1. Let's say you're up 3-to-1. You made 3 Rs on the position. You take another 50%, right? So we took $100 off the table here. We have $100 left in the position. From here, it goes up to 3 Rs. You take another 50% out. So now you have a quarter left in the trade. And then you trail the rest of it, where you raise the stop loss and you let it stop you out for the rest of the position. Or if you make 5 to 7 Rs, you take full profits no matter what. So if you're in a trade, hits 5 Rs really fast, let's say, you take full profits no matter what, right? This is another really, really great option. So it's up to you what you want to do, right? And a couple of other things I like to have in my plan is if a trade triggers you in but doesn't give you follow through, like let's say you get into a trade but it doesn't go right away, it doesn't go in your favor right away, and it sort of just chops around at your entry, look to get out quickly, right? This is a great thing that you can do, right? Like if the trade doesn't immediately work in your favor, look to trail tightly, look to get out quickly because there's something wrong with it, right? If the trade's not, playing out to your thesis and to your conviction, and it's just chopping around your entry, you could just get out close to break even. If you have really high conviction on a trade, you're going to have looser management, right? You're not going to be trailing as tightly. You're going to give the trade room to fluctuate to ultimately continue in your direction to your, to your target. If you have low conviction on the trade, let's say there's a trade where it's good enough to take, but you're not that confident, you could have tighter management, so you limit your losses, or you could take faster profits. This is just a framework, guys, and this is how I would structure it. If you're up 1-to-1, what are you going to do? If you're up 2-to-1, what are you going to do? If you're up 3-to-1, what are you going to do? When are you raising your stop loss? When are you going to trail to break even? All these things should be on your mind, guys. So trade management, very important. Another, are you leaving a runner, which is kind of what we talked about as well. But you have to think about how you're going to manage the trade before you're even in it. Next, guys, I have a bunch of super good rules that we could follow. I'm going to kind of hurry up here. We only got around, 2 more minutes? Not even. So trading rules. Your system is only going to be as profitable as how strict your rules are. I don't even know if that makes sense, but you get the idea. Your plan needs to be extremely strict off what you can and can't do in the markets, right? If you're building a building, right, it's gonna be very strict for where you put the blocks, how you build the foundation, how you build the support for the structure. Same thing with trading. You need to be extremely strict with your rules. So here are a couple of rules that you could use. All right, protecting profits, right? One really good thing you could do is protect 70% of your daily profits. If you're up $1,000 on the day, you have to protect 700. This is a really good way of making sure you're retaining the money that you're making, that you're keeping the money that you're working on, right? A lot of people don't do this. They'll make thousands of dollars and then they'll give it all back that day and then lose money. You need to have rules. If you're up a certain amount, you have to keep by the end of the day a certain percentage. Another example of this is you're up 3 hours on the trade, you need to protect 2. All right, so very important. If you're up 3 hours, you're up, let's say you're risking $50 and you're up 150 on the trade, you have to protect at least $100. You need to have rules to protect profits so you actually keep what you're making. Okay, next. Cannot over risk. This is, obvious. Predefine your max risk. We already talked about that in the determine your risk. You risk what you're okay with losing and you can't over risk. You have a maximum risk, you stick to it. You're strict with your maximum risk. And you need to predefine your max risk before you take the trade. And then you have to size it accordingly. Size the position accordingly. So if it does hit your stop loss, you lose what your max risk is, or you lose less than your max risk. Okay, very, very important. Next, what do we got? Never add to a losing trade. Guys, please don't do this. I saw my dad do this at some point when I first started trading. He did it. He ended up making money on the trade, but after it, he was like, do not ever do this. If you're in a losing trade, it's probably for a reason. Why would you add to a losing trade if it's not working? Why would you add to a failing trade? Doesn't make any sense. Never do it. Never DCA in. I know your thought process. I know you're like, oh yeah, well, if I add to it, it decreases my average price. And then if it moves up a little bit, then I'm going to be back to break even or in profit. Don't do it. Save yourself the money that you're going to lose. Just don't do it. Trust me. It's a cardinal rule. Next, you have to have rules when to step away. If you feel emotionally or psychologically compromised, or if you have more than 5 losing trades in a row, or if you lose your maximum daily risk, or if you feel those emotions trickling up within you, step away. Very, very important. You have, and this is like personal, right? Like you have to think about it yourself. Like when you feel certain emotions, you have to step away or go on a walk or go talk to your friends or whatever you got to do. But if you're feeling emotional, you have to know when to step away from your office. All right, guys. Next, no outside beliefs or biases. This should be a very, very important rule. Don't read earnings reports. Don't read the news. Don't read financial statements. Don't listen to your friend who thinks he's an expert on investing, who only took like 1 college course. Don't listen to your financial advisor that your dad recommended you. Maybe for investing, but we are trading. As traders, we exclusively focus on price action. That's what we do as traders. We don't focus on outside news, outside beliefs, because most of the time, all these beliefs, all these news, all this information is already priced into the stock. Only focus on price action and the relationship between the buyers and the sellers. Now, these are rules that you could have. Just example, but you need to have rules, right? Very important rules. Another rule that you could have is if you lose 2 or 3 trades in a row, right, lower your risk to a certain amount. And then once you have 1 or 2 trades in a row, winning trades, and you're feeling confident again, that's when you could scale your risk back to what you're comfortable with. All right, guys, we went way over 20 minutes, but I don't care. This is going to be a banger video. All right, next, practice pair, right? What's pair? Prepare, execute, analyze, refined. You're going to be doing this through journaling, All right, it's very, very important, guys. The only way you improve as a trader is to improve your system. So what do? You prepare your trading plan. Exactly what we just did, you're gonna do it for yourself. Once you prepare it, you execute that plan. Take 10 trades, 20 trades, 50 trades, however many is enough for your own style that establishes a large sample size. From there, analyze what you did wrong, analyze what you did right, analyze what makes you money, identify what loses you money, identify strengths, weaknesses, how you executed your trades. Did you follow your risk? Did you follow your plan? Did you follow your rules? What setups are working for you? What setups are not working for you? Once you analyze all of that through journaling all of your trades, which is very, very important, you're gonna refine your plan. This is when you go back into this giant plan that we just made and you refine it. You could refine the certain qualities that you need to see for a setup, right? Or you change your risk, or you change your management, right? Analyze what management ends up making you more money. Does raising your stop loss to break even after 1-to-1 R to R make sense for you? Or does taking half profits at 2-to-1 make sense? You have to analyze all of this and ask yourself, right? Ask yourself, is this making me money? Is this actually effective for me? And from there, you make the changes. You go back to your plan and you change stuff up. And then what do? As you're changing it, you're re-preparing your plan. Then you execute it again on a large sample size of trade. Then you analyze and you improve. Pair. Guys, if you build this plan out based off your style, you do all of this, right? You have clear rules that you can and can't do in your trading. You have very clear trade management on where you're taking profits, how you're trailing, how you're raising your stop loss, what to do when it hits target 1, 2, or 3. You actually, like, if you have all of this, you know what your risk is, you know what setups you're looking, or what qualities you're looking for in your setup. You know the setups that make you money. Like, if you have all this listed and then you're actually executing it, analyzing, refining it through journaling, it's impossible to not improve. You will 1000% improve over time. All right, guys, this is what I would do. This is what I did when I first started. At this point, guys, I don't really have a plan on paper. My plan is ingrained within me. It's ingrained within my brain, ingrained within my DNA. Now I just know what my plan is. I am my plan. I am the system that I created for myself through 5 years of experience. That's who I am, my system. The reason I'm able to make money consistently is because I have a system that works for me. And you need to find a system that works for you. That is the goal here, all right? Please actually apply everything that I just taught you in this video. Trading psychology is one of the most important components of becoming a profitable trader. And in this chapter, that is exactly what we're going to be talking about. I'm going to share with you my 5.5 years of trading psychology experience and exactly what I would focus on to improve your mindset, to improve your ability to control your emotions, and of course, to improve your overall trading psychology. So let's hop right into this chapter. Now let's go ahead and get started with the actual class. I have a shot clock right here. We'll do 17 minutes. All right, let's get it going. So the worst advice that I see all the time on social media about trading is trade like a robot. This is the worst advice that you could hear, and it's literally impossible to apply. We, ladies and gentlemen, are not robots. We are human beings, and as human beings, we have emotions. They are inevitable. Our job as traders shouldn't be to not have emotions. It should be to learn how to control those emotions. That is the difference between you making money with trading and you being an extremely successful trader. It's the difference between success and failure. Your ability to control your emotions and master your trading psychology, but you need to accept that they exist. They're going to happen. And your priority, stop focusing on not having emotions, focus on learning how to control them. And ultimately, there are 2 emotions that are rooted in every single trading issue that exists within your trading psychology. It all comes down to 2 different emotions. And we're gonna talk about the first one, which is greed, right? And by the way, this is every issue. Every issue, oops. Almost dropped the mic. Every issue that is within your trading ultimately comes down to greed. And there's one more that we're going to talk about in just a second. But what is greed? Greed is your desire to make money. And ultimately, your strong desire to make money is what's stopping you from making money. And we're going to go over the exact ways that's actually happening. The first way is over trading. This is when you are taking way too many trades. But to be more specific, this is when you're taking low quality setups. You're forcing trades and you're trying to force profits, right? You're forcing setups that aren't there, that don't actually fit the criteria in your trading plan. Why are you over trading? Ultimately, you want to make more money. Why do you want to make more money? Because of greed. This ties into greed. You need to really accept that. So how do we fix over trading? Like if you're over trading right now, how do you fix it? Well, you need to have a very detailed plan of what goes into a high quality setup and what goes into a low quality setup. If you don't have a plan like that, you're never going to become successful. When you're looking at the charts and you identify a setup, there should be like alarm bells in your brain that are like, yep, that's a high quality setup, or nope, that's not a high quality setup. There's specific qualities, criteria that go into it being high quality setup. This needs to be written down. So when you're looking at a trade, you can identify, is it a good setup or a bad setup? If it's a bad setup, don't take it. You don't trade that setup, right? If you do trade it, that's over trading, right? You only focus on A- to A+ setups, maybe occasionally a B+ setup if you're feeling aggressive. Now, if you don't know the criteria or the qualities that go into A+ setups, I highly recommend watching my free 10+ hour course. You could find that in the description of this video. It'll be linked. You could start it. It's 100% free. It's 10 hours long. It is genuinely better than most paid courses on the internet. It'll teach you all of this stuff. The next way that greed could be affecting your trading is over leveraging or over risking, right? You could, trade profitably and make a bunch of money for 3 months, 6 months, a year, and then one trade, you can give it all back. One trade can ruin your account by over leveraging or over trading. Now, why does this happen? It happens because you have a desire to catch a big trade and to make a ton of money. Ultimately, because of greed. The way to stop over risking and over leveraging is honestly be disciplined with your plan, right? When you, in your trading plan, you should have a specific risk that you cannot go over. Like for me, I can't lose more than $500 to $600 on a trade. I just can't do it. It's not in my plan. Like if I don't ever do that. I'm very, very strict with it, right? The way to stop over leveraging and over risking is to be strict with your plan and to have a concrete risk that you cannot go over in a specific trade or in a specific day. Have a rule where you can't lose X amount in a specific day. Like for me, if I lose more than like 1,000 or 1,500 in a single day, I'm done with the day. I'm done trading. You need to have that rule for yourself. You need to have rules that limit the amount that you lose in a day or in a trade. Okay. The next way that that greed can kind of materialize in your trading is through revenge trading, where you take a setup on a stock or whatever you're trading, you lose on it, and now you have feelings, you have those emotions to essentially make your money back, or make your money back and then also make profit. This actually plays into the next emotion we're going to talk about. We'll talk about that in just a second. But what is revenge trading? You're trading because why? Not because there's a quality setup, not because there's specific criteria that you like to see. You're trading because you lost on that setup, and now you're trading it again to make your money back. That's not a reason to take a trade. Just because you lost on a setup that's not a good enough reason to take that setup again. You need quality criteria to take a trade, right? So you're forcing profits. You're forcing yourself to, either break even on that trade or to make money back. Ultimately, this materializes in greed. How do you fix revenge trading? What I like to do is, if I lose more than 2 to 3 times on one stock, if I'm scalping it, I remove it off my watch list. It's a really great way of doing that. If you're only trading 1 to 2 securities, maybe you only trade NQ or ES or something, in that case, you can, after 2 or 3 losing trades, you're done for the day. and you limit yourself, right? You just got to be disciplined with it, right? So have rules in place for over risking for the maximum amount that you could lose in a day or on a trade, and have rules for revenge trading where you stop trading after 1 or 2 or 3 losing trades. Okay, next, another way greed can materialize in your trading is impatience. And this is not even like from a trade to trade basis. I'm not saying like being patient within a trade. I'm talking about the impatience of trying to make money and become a profitable trader as soon as possible. Okay, a lot of times, most people who get into trading, I talked about this in my last video, you're not actually interested in becoming skilled traders. You're not actually interested in learning, what goes into a high quality setup, or how to manage risk, or how to manage your positions correctly. You're just focused on making money. You're not actually interested in becoming a trader. And you're impatient. You're so, eager to make money that you skip the process, where you try to cut corners, you skip certain steps. And you just have to, for this, you have to change your expectations. When you're going into trading, stop thinking about the money. The more you think about the money, the more it runs away. The more you think about becoming a skilled and profitable trader and focusing on the process, the more money comes to you, right? I've never met a really, really good trader that doesn't make money. But I've met a ton of people who want to make money with trading who don't, right? Focus on becoming really, really good and the money will come to you, and that could take time. You need patience, right? Trading, think about it. You go to school for 4 years to get a degree that doesn't even guarantee you a job, but you're not willing to spend 3 to 12 months to become profitable. Doesn't make any sense. You have to shift your expectations and be patient with it. Focus on learning the actual skill set. Don't focus on the outcome. Next, holding too long. This is when you're in a profitable trade. The trade is making you money. You're up, let's say 2 hours, 3 hours. You're feeling super good. And then you decide to hold too long because you want to make more money. And this is when you ignore your exit plan because you want to hit that home run trade. You're not happy with 2 hours. You want to make 4 hours. You're not happy with $1,000 profit. You want to make $10,000 profit. Your desire to make more money on that trade is stopping you from making any money at all. If you're up, let's say $1,000 on a trade, you could take partials, take half, take $500 off the table, take $750 off the table. You're still in the trade, but you took some profits already, versus you're up 1,000, you want to make 3K, and then all of a sudden you ignore your exit plan, and next thing you know, it becomes a losing position. That's ridiculous. That ultimately comes down to greed and you just wanting to make more money versus focusing on actually trading the right way and following your exit plan. If you don't have an exit plan, I would watch my free 10+ hour course. I go over how to create an exit plan. It's extremely useful. Everyone should have a plan on entering into a trade and a plan on exiting that trade, okay? You can't have one without the other. Next, guys. So this is all about greed, right? If one of these is your issues, that's because of greed, and hopefully some of my solutions helped you out there. Now, the next emotion is fear. There's greed, your desire to make a lot of money, and then there's fear. Fear is being fearful that you're gonna lose money or fearful that you're not gonna make money, okay? The first way fear materializes is the fear of being wrong, and I have just around 7 minutes, okay? The fear of being wrong. A lot of times I see beginner traders, they're more interested in being right versus wrong versus making money because their ego plays into it. They can't handle their ego being wrong, where they enter into a trade, they're so confident it's gonna go higher, they're so confident that's gonna happen, that when it moves lower or when it doesn't play out the way that they think it's going to, it hurts their ego. It hurts to be wrong. And you can't do that, right? You can't be focused on being right or wrong. That's not what trading is about. Trading is about making money, okay? So if you feel like your ego plays a heavy role in your trading, you need to find solutions to that. You have to realize that, you should have a much stronger desire to make money than to be right. And sometimes the best way to make money is to limit your losses. All right. So if you have the fear of being wrong, you have to shift your perspective and focus more on making money versus just being right. Okay. Next, fear of losing. This is when you are risking money on a setup and you hesitate. Where let's say you see a really high quality trade and you hesitate on that trade, or you second guess yourself and that trade actually works in your favor. And then you're thinking to yourself, why didn't I take that trade? I knew it was going to go down, or I knew it was going to go up, but I didn't take it. Why am I so stupid, right? It's happened to me. This ultimately boils down to your fear of losing. You're fearful that the money that you risk, right, you're going to lose it. You're fearful that you're going to lose money. The way that you fix this is to, number one, lower your risk. You're risking way too much money if you have a fear of losing money. You have to pick, when you decide how much you're going to risk on a trade, you have to pick an amount that is not going to kill you if you lose that amount, but it's also not going to be so low where you're like, I don't care. Like if I risk $10 on a trade, I don't care, right? Okay, I'll lose it, I don't care. But if I risk 500 on a trade, on one hand, I'm not going to feel that affected if I lose it. But if I do lose that amount, I'm still going to kind of feel it, right? You have to find that sweet spot. But if you're like actually fearful when you're entering into a trade, it's because you're risking way too much, right? Lower your risk to the point where you're comfortable with losing that amount. And then you're not going to have that fear of entering into trades, because worst case, you have your stop loss. You know exactly how much you're going to lose. So it's okay. You know the worst possible outcome when you enter into a trade. You're going to lose what your predetermined risk is. And you need a predetermined risk. You need that in your trading plan. FOMO. You fear you're missing out on the trade of the century, so you break your plan and you overtrade. A lot of people go through this, the fear of missing out. This is when, you see a trade, you feel like you're missing out on it. Maybe you were late to it. Maybe you didn't spot it in time. Maybe you passed on the position. You just let it, you didn't decide to take it. Then it starts to move in your direction and you FOMO into it because you fear like you're going to miss out on some amazing opportunity. Understand there are hundreds, there's going to be thousands, tens of thousands opportunities in your lifetime, in your trading career. You're going to have trades that same day. You're going to have a trade the next day. You're going to have a trade the next week. Don't get so caught up on one trade that you end up getting into it late because of your emotions, and then you end up losing money. There's plenty of opportunities to make money in trading. Guys, this past week, there was a trade that if I kind of misplayed it. If I played it right, it would have made me like 20 to 30K, I swear. And instead of FOMOing in late, I was like, you know what? It is what it is. I'm going to let it go. It was a tough pill to swallow, but I had to do it, right? So just understand there's going to be plenty of opportunities. Don't get so caught up on one trade. There's going to be thousands of setups in the markets, all right? Next, fear of not being good enough, lack of confidence, switching strategies. So ultimately, lack of confidence and switching strategies, this is going to boil down to the fact that you're not confident in your trading. You're not confident in your ability to make money. Maybe because you're a beginner, or maybe because you're not profitable. Honestly, the best way to actually fix this is to have a coach or a mentor in your trading. And it doesn't have to be me, it could be anyone, but someone that could show you how to trade the right way and someone that you could trade with every single day. If any of you guys are looking for a full-time coach or a mentor, I do have a mentorship program. I will be completely transparent, where I take traders under my wing and I scale them from zero to $10,000 to $50,000 a month with trading. I trade live every single day. I take you under my wing. I teach you from A to Z. And ultimately, we're trading together every single day. You're learning how to trade by doing it with me. I share my screen. We're on the same call. We're trading together. We're making money together. And most of my students, they never have lack of confidence. They never switch strategies because they learn how to trade correctly from the very, very beginning. All right, guys, we have just about 1 minute and 30 seconds left. So if you do want a full-time mentor, you're serious about becoming a full-time trader, you want to do this as fast as possible, you don't want to figure it out by yourself, you can apply in the link in the description, and we could see if this is a good fit for me to work with you and for you to trade live with me every single day, guys. Next, in terms of fixing a lot of these trading psychological issues, we kind of talked about it, but real quick, something that's really helped me is start the trading day in the green, even if it's a small winner. When at 9:30 hits, the opening bell hits, make sure your first trade is a winner. Even if it's a small winner, even if you have to lower your risk, make sure it's a winner. Me doing this was a game changer for me. when I start off the day positive, I just have such a different psychology moving into the rest of the day. Just do it and you'll see the results. Create a trading plan. I'm not going to go over it in this video. Just subscribe to this channel. This is the next video that I'm making. When in doubt, always lower your risk. This is so freaking important. Whenever you're emotional, you're feeling doubt, you're feeling lack of confidence, you're feeling anything that's not a positive feeling in your trading, lower your risk. Always lower your risk in times of doubt so you can protect your downside. Another thing you should be doing is focusing on becoming a break-even trader before becoming a profitable trader. Most people try to go from losing or a beginner to profitable. Instead, you should be going from beginner to break-even trader to profitable trader. That step in the middle is extremely important. Oh, there's a timer, but real fast, we'll finish these. Step away when you feel your emotions get to you. Just step away from your desk. If you feel like you're getting emotional, have rules. And ultimately, guys, every single one of these issues in your trading, the greed, the fear, over trading, over leveraging, revenge trading, impatience, everything, fear of losing, it all boils down to your discipline. Being disciplined and making sure you do the actionable steps within your trading plan to prevent all of this from happening, whether that's you stepping away from your trading desk, whether that's you lowering your risk, whether that's you having rules on how much you could lose on a day or on a trade, whether that's just specific rules just to you for how to not overtrade or to how to, or what to do when you feel FOMO, whatever the case is, you need to be disciplined with your rules. That's what's going to help you with all of this trading psychology. All right, guys, that's the end of the video. Make sure you subscribe to the channel. Make sure you leave a comment if you found this valuable. Leave a like. It helps the YouTube algorithm. And hopefully you found a tremendous amount of value in this video. Thank you, and I will see you guys next time.